Yes, sir.
Traveling in a car?
Yes, I'm traveling. I'm in the airport. I just thought I'll give a 5-minute thing and then go for security.
Very kind of you.
Yeah. Yes, sir.
Very good evening, delegates. Welcome to today's program. The other commercial laws, we are going to deal with the 3 laws: IBC, labor laws, and banking law, which will be dealt by CATR Chandrasekharan sir, banking laws, CR Venkatakrishnan IBC, and CAB Shivaraman, labor laws. We will start today's proceedings with the invocation of ICAI motor song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनाद्यपि कश्चन एतद्वैता
Thank you. We have with us CA Revati S. Raghunathan, Chairperson CPE Committee. May I now request ma'am to formally introduce the speaker and give her a welcome address.
So ma'am is disconnected.
Since madam is in airport and she wants to move, she might have disconnected. No issues. I will introduce Chandrasekharan Ramaswamy sir. It's my pleasure. T.R. Chandrasekharan Ramaswamy is the former director and audit committee chairman of Karnataka Bank Limited, Mangaluru. He is the former independent director, Sanco Trans Limited. Yeah, we have madam joined again. Madam, over to you, ma'am.
Yeah. So good evening, friends. Welcome to this session on other laws. We had actually planned this session so that, we can upskill ourselves, update ourselves with the other laws which are applicable when we are finalizing our financial statements for this financial year, assessment year. So we could think of none better than the 3 speakers, TRC sir for banking laws, and CA Venkatakrishnan for insolvency, and CA Sivaraman for labor and PF. In fact, if you see, these are the laws which have a great impact on our financial statements, and knowing the impact of these laws as we finalize the statements is the need of the hour now, because there are so many compliances which we have to meet, and being up on these compliances and enabling this is what our motto in SIRC is right now. So thank you all for joining us, and thank you sirs for also joining us for this program, sparing your valuable time and also sharing your knowledge with us. I think TRC sir, CA TR Chandrasekharan, a senior banker by profession and philanthropist in heart, and he generously immediately accepted when we asked him if he would come and share his knowledge with us. Thank you, TRC sir, and my place on record my thanks to the other 2 speakers also who have obliged us by actually accepting immediately to share their knowledge with us. Thank you. Thank you very much.
Thank you very much, madam. Thank you.
Yeah. Okay, so Rahman, you will do the introduction of TRC, sir, and proceed. Yes.
Yeah, sure, madam.
Yeah.
Sure. Madam.
Thank you, Revati.
Yeah, thank you, sir.
Actually, madam is joining from the airport. She made it that she want to do the welcome address. Yeah, thank you very much, madam. Thank you.
Thank you so much.
It's my privilege to introduce T.R. Chandrasekharan, sir. As said earlier, he is the former director and audit committee chairman of Karnataka Bank Limited, Mangaluru. He is the former independent director of Sanco Trans Limited, Chennai, independent director of Ind Bank Housing Limited, Chennai. He is a BCom graduate, a fellow chartered accountant. He also holds a diploma in labor law and admin law. He has got 30 years of experience in banking sector, as earlier reiterated by Revati Madam. And he served as a vice president of Indian Bank Mutual Fund, nominated to the Ind Bank Merchant Services Limited as its director, and part of the member of the team successfully turned around the bank to profit-making bank during the year 1999 to 2003. And he retired as the deputy general manager in charge of accounts and audit, and gained good exposure to the statutory, central and bank branch audit and RBI norms relating to audit. From 2006 onwards, he conducted statutory, central audit, concurrent audit, revenue audit, risk-based audit system, system audit on nationalized bank and private sector banks. Being the director and the ACB chairman of Karnataka Bank, for the exposure to all the areas of banking enabled him to locate the problem areas and able to provide solutions for the same immediately. Proper directions were given to the bank for progress interact with the SCAs and RBI top financials. He also acted as a faculty of Indian Bank Management Academy for Excellence and Growth, and faculty of our institute since 1983 on bank audit. Submitted several papers on bank audit, LFAR, presentation, tax audit related to banks, assessment of NPAs and RBI norms, accounting standards applicable to banks, disclosure requirements in bank accounts, reporting requirements in the audit of banks, etc. Presently specializing in IFRS as applicable to banks and risk-based supervision. He is also into practice since July 2006. That is the Chartered Accountant Day. He started his practice way back in the year 2006, and he was the co-opted member of the Committee on Corporate Governance of ICAI New Delhi for the years 7 and 8. He was also the member of study group constituted by ICAI on redrafting guidance note on audit of banks. Okay, that's great. He's also the member of a study group constituted by ICAI New Delhi on NPA management in public sector banks. So with this brief, I have great pleasure in welcoming Sir T.R. Chandrasekharan, sir, fondly called as a TRC, to handle today's session on banking laws. Over to you, sir.
Thank you very much for the introduction. And I welcome all the delegates for this session. And this is only a sharing of my experience in the field of banking. And before we go to the PowerPoint presentation on this subject, let us have some brief details about the banks and the laws applicable to banks. As I have analyzed the various acts that deal with the banking, etc. For example, first is the Banking Regulation Act, 1949. Then comes the Banking Companies Acquisition Undertakings Act of 1970 and 1980. Then Reserve Bank of India Act. Then other acts such as Income Tax Act, SIRC Act, IBC Act, everything which has a relevance on the banks. So that I have selected some of the sections which are applicable and which has to be carefully gone through by the auditors while they're certifying the balance sheets of corporate concerns or any concern for that matter. So this is the basis on which I start my presentation. And any doubts arising during the presentation, you may raise it, and it will be answered immediately to the extent possible. And we will now go to the PowerPoint presentation.
Yeah, members, those who are having doubts, you can either ask in the chat box so that sir will answer, or else you can ask at the last, around 6:45. Am I right, sir?
Yes, sir. Around 5:40.
Please.
5:45.
Yeah, 5:45. Please proceed, sir.
Right. Thank you. The general laws governing the banks are Companies Act 2013, originally 1956, Insolvency and Bankruptcy Code 2016, Securitization, Reconstruction of Financial Assets and Enforcement of Security Interest Act, that is SARFASI Act, Income Tax Act 1961 and subsequent modification, and the Reserve Bank of India Act 1934, Foreign Exchange Management Act 1999. These are all the acts which the persons who are supposed to do audit or make any comments on the finalized accounts of the banks or financial institution should go through. Next slide. Acts governing exclusively banks and relating to audit. Banking Regulation Act 1949, Banking Companies Acquisition and Transfer Act 1970, which that 14 banks were nationalized. The Banking Companies Acquisition and Transfer Act 1980, where another set of 6 banks were nationalized. These acts deals with several things. For example, banking regulations talks about how to start a bank, what is the minimum capital requirement, how many directors can be there, what is the board, what is the power of the board, when the liquidation of the bank can also take it, what is the powers of the Reserve Bank of India. All these are mentioned in the Banking Regulation Act. Similarly, the accounts and audit are also mentioned in the Banking Regulation Act. And the Banking Regulation prescribes the audit format in which the auditor has to submit. That format still today also continues, despite other certificates you have to attach along with the bank's balance sheet. The Banking Companies Acquisition Act and both the acts speaks specifically about the audit and other aspects of banking companies. Next slide, sir. Section 10 of the Banking Companies Acquisition Act and deals about 30 of the Banking Regulation Act, 139, 141 of the Banking Companies Act, and RBI and the CNDAG. All these persons have got power to control the accounts and audit of the banks. For example, Banking Regulation Act applies to all the banks, most preferably on private sector banks. Whereas the Acquisition Act and other Companies Act applicable to nationalized banks as well as Companies Act concern other banks also. Because unless these sections of these acts are contradicts each other, all the sections are applicable to banks. Sometimes, for example, Banking Regulation Act says what are the loans and advances that cannot be given, because we are all familiar with the advances what is given by the branches. When we go to the branches or banks, we start checking the advances given by the banks, whether the documents are there, whether the security is there, whether repayment is there, all these things we verify. But we never verify whether the advance given by the bank is under their capacity to give, whether it is the law permitting such advances to be given by the bank. That is the most important aspect one has to go through. Similarly, section 113, 120 again says the audit of companies. Audit, see, that is also applicable to banks, because now all banks are coming under the company side also. So those sections are also applicable. So one has to go through all these sections and have an idea about to what extent these sections are applicable to the bank which they are going to audit. The bank may be nationalized bank, the bank may be quasi-nationalized bank, quasi-private investment, and certain banks may be 100% private investment. So it may be, irrespective of the cadre in which they are coming, these acts are applicable to them. And as far as the audit is concerned, the RBI and the CNDAG have got power to recommend auditors both to public and private sector banks. So though the act says it should be audited by a chartered accountant, but which chartered account decision is taken by the CNDAG and RBI in consultation with the Institute of Chartered Accountants. So the panel is compiled by these 3 people and that is given to the banks. Next. The type of advances which are prohibited by banks to be availed by public, one is statutory restriction is there in respect of sanctioning advances, giving advances. Then there are regulatory restrictions. Reserve Bank of India is the regulator for all the banks. So they give instruction what are the loans can be given, what are the loans cannot be given. Then restrictions on other loans and advances, which may be coming under the statutory regulation or regulatory regulation, but still the separate part is there for restriction other loans and advances. Next. Next, sir. statutory restriction, we will go one by one. Advances against banks' own shares as per section 21 of the Banking Regulation Act. The bank cannot grant any loans and advances on the securities of its own shares. So whenever you check advances against shares, you should check whether the advance is given on the security of the same bank shares, which is prohibited by the Act. Because the bank cannot fund its own finance for the purpose of acquiring shares of same bank. Because the prime right on the shares is held by the bank. It cannot be given to any other person in the form of a security. Banks are prohibited from entering into any commitment for granting any loan or advance or on behalf of any of its directors. Any firm in which any of its director is interested as partner, manager, employee, or any company which is subsidiary of a company which they are the auditors for their directors, relatives, etc. So one can ask the question, sir, by checking the advances, how can one know, or the auditor know, whether the advance is given to its directors or some other bank directors? How do you know that? I know one Ramachandran name is there. He has given 1 crore of advances. Security is given is a house property worth 2 crore. Then repayment, everything is coming properly. Then what is the wrong in that advances? I don't find any, because as per RBI norms, it's very clear and good advance and performing advance. But how do we know that it is a loan given to the directors? That is the small click at that. One, the person who goes through the verification advances must go through the application form. The application form should come from the borrower to the bank stating that I want the following loans. Then the application to be filled up, which is given by the bank, which requires a column. Are you a director in any other bank, or any relative or director in any other bank, or their subsidiaries, etc. Are you a director in any other bank or this bank? So these questions should be asked. So there you have to verify whether he is a director or not. So it is not an undisclosed information. It is a disclosed information in the application form. So you have to verify that whether the loan is given to any director or not. If the loan is given in such a manner, violation of section 21, the entire agreement is void ab initio. From the beginning, it is illegal. Banks are, so once an account becomes illegal, it is 100% provisioning account and the NPA account will become. And action will be taken against the officers who are sanctioned advances. And if the auditor is not pointing out this mistake, despite the fact he has gone through the application, the question will be asked from the auditors also how he missed it from your rights. Banks are prohibited from entering into any commitment also, not only giving loan, but commitment also, either in the form of a guarantee or opening of LC credit or giving a letter of credit or letter of worthiness of the borrower. All these things are also prohibited by the bank in the case of its directors or directors of other banks or directors of the subsidiary companies. Next. Next. Section 20A of the Banking Regulation Act 1949 stipulates that a banking company shall not, except with the prior approval of RBI, remit her own or part of the debt due by its directors. The previous section says you should not give any loan at all. This section says we should not remit any loan given. Is there any contradiction? Is there? No. The first section is applicable from a particular date onwards. This section gives the retrospective effect. If already loan is given before coming to the section, that has to be rectified. So that was, they say not only once the loan is given, the bank has no power to remit it or waive it or write it off or make provision, etc. So any of his debt due with no remission of any debt taken by but the exemption is given to the loans given to the directors and officers, etc. Such exemption is loan against its own deposits. Suppose a director is having deposit, fixed deposit in the same bank, he can raise a loan on this 90%, nothing wrong in it. So this where the loan is given without any purpose is something else, not for the purpose of availing loan from the banks on its own deposit. Other loans are prohibited. But in the case of employees, also restrictions there that will come in another slide. So the firm and company in which director is interested as director, as a partner, managing agent or guarantor, any individual which directors, partner, guarantor or subsidiary companies also. For example, I am a director in Inbank Housing Limited. So Indian Bank cannot give any loan to me because I am a director in the subsidiary company. So that restriction, it is not necessary I should be the director in Indian Bank. But even if I am a director in any subsidiaries of Indian Bank, which is hold more than 51% share, then naturally Indian Bank cannot sanction a loan to me. Next slide, sir. Without approval of the board, loans and advances should be granted to relatives of the bank, directors or directors, other banks, and relative directors like subsidiary companies, etc. That is, if loan is going to be relatives of the bank, directors or directors, you should go to the board for their approval. So and so has applied the loan for this bank, but he is a director in some other, his relative is a director in some other bank. So can the loan be given? So having considered all these aspects, etc., only the loan can be sanctioned, but that can be sanctioned only by the board of directors, not by any topmost executives of the bank. So these sort of things, avoiding using the influence to get the loans, because normally a person who occupies the position of a director may influence the bank to sanction loan, etc. In order to prohibit such things, these sections were introduced. So while we go through the audit, we go through the verification advances, we must go through all these things instead of simply verifying whether the security is there, repayment is there, whether it is NPA, non-NPA, etc. Normally, when we go to the branch, we concentrate main on the NPA aspect of it and ignore sometimes these aspects. That is why I brought to the knowledge of the auditors. These should also to be considered without any exceptions. Next. Next slide, sir. Restriction on advance loan to officers and relatives of senior officers of banks. Exceptions are loans and advances as per rules. As in the case of employees, there is an agreement between the officers union or the trade union and the IBA, Indian Bank Association, and Reserve Bank. They will give, these are the advances that can be given to the employees because of the employer-employee relationship. For example, taking festival advance, taking housing loan, or taking car loan, there are prescribed limits are fixed, etc., how it can be given, etc. So those advances can be given. Suppose a person is having a business, the employee is having a business, he cannot take a loan for his business because that is beyond the capacity and beyond the rules of the game. So that to restrict the employees using their influence to get unauthorized loan, these sections are introduced. So whenever you go to the branch and check up the loans and advances, you check up the staff advances very much and see whether it is properly recovered and see whether it is within the permissible rules prescribed by the banks. Each bank will give a separate circular for what are the advances eligible by the staff. So we should see whether those advances are coming under that category or beyond that category. If it is beyond that category, it has to be reported to the auditors in their report. This is also applicable to officers of the other public sector banks also. Suppose I am an employee of the Indian Bank, suppose some other bank employee also comes and apply for a loan in the Indian Bank, Punjab National Bank or Canara Bank, etc. Then such cases also they should get permission from the other bank to raise loan. Because whatever the repayment capacity of this particular employee, the first charge is given to the original bank that he is serving. So whether his capacity is, after meeting their commitments, he is capable of paying this or not, that has to be verified. So that is why they say even the officers of the other banks should not be availed by the another bank. Next. Rule regarding sanction of loans and advances are equally applicable to relatives of senior officers of the bank, will apply to the relatives of other senior officers of the participant bank. So there are big advances which participating banks, there is 3 or 4 banks joined together. Suppose some company wanted to avail 1,000 crores advances. So one single bank cannot sometimes. Or risk-based basis, we don't want to take the under 1,000 crores risk, so we will share it. So sometimes what will happen is that Punjab National Bank, Canara Bank, or Bank of Baroda will share these advances at the rate of 300 crores, and some other small bank will take 100 crores. So even in such cases, such type of advances is shared, etc. Those officers of all the consortium banks also coming under the category of not availing loans, except for the purpose mentioned in the agreement. Next. Restrictions on other loans and advances. Caution on loans and advances to public against shares, debentures, bonds, follow. That is, any advance given on the basis of shares, the bank should work caution on it. That is, the caution is in respect of margin, caution in respect of amount, caution in respect of person, everything is there. So seek to borrow a margin, the purpose of the loan. What is the purpose of the loan? The purpose of the loan should not be acquiring more shares for the purpose of trading in shares. It may be for the purpose of business. I have 1,000 shares of Reliance. I can give as a security, get a loan for the purpose of business, but not for the purpose of acquiring future shares of the same company. Then every bank should have a policy about this sanctioning of advances against shares. So that policy should be explicitly mentioned, and it is to be available in the website. And so the person who was verifying these advances should show the policy, what is the policy of the bank, whether the loan is given as per the policy or beyond the policy. Especially the margin and purpose is very, very amount. And sometimes the stock exchange will prohibit certain shares in the trading market. So such shares also should not be taken as a security for this purpose. Advance against other banks' fixed deposit receipts. This is another important condition. The Indian bank cannot sanction loan on the fixed deposit of Punjab National Bank, because the simple reason is the primary lien on the fixed deposit of Punjab National Bank rests with Punjab National Bank. So after exhausting their liability only, it can be go to some other person. So that is why banks are prohibited from sanctioning advances against other banks' deposits. No loans and advances against gold, bullion, primary gold, etc., but not on gold jewelries. Gold jewelry you can give as a security in the form of a necklace, bangles, all these things given and take a loan on it, but not on the gold, bullion or primary gold. This is the Reserve Bank of India's condition, so this cannot be given, because hoarding and other things should not be done by means of taking a bank finance. Sometimes the banks issue coins, gold coins, as permitted by Reserve Bank of India. Such things you can buy, and that you can keep it, and even loan can also be raised for that purpose, but not for the purpose of, even for purchase of gold jewelry, you cannot sanction a loan. You can sanction a loan against the gold jewelry as a security. Next. The balance sheet and profit loss account prepared in accordance with Section 29 of the Bank Regulation Act shall be audited by a person duly qualified under law for the name being enforced to be an auditor of company. Company law includes banking, acquisition, all the acts. So the person should be a chartered accountant who is going to audit the. It may be a firm, it may be an individual, whatever it is, but it should be. But the form, etc., should be approved by the Reserve Bank of India and C&AG purpose of audit. So the normal procedure is we apply it through our PDA, then it goes to C&AG. C&AG verify all these things. Then they recommend to Reserve Bank of India the list of auditors that can be appointed for the purpose of banks. Then Reserve Bank of India send the list to the various banks. These are all the auditors eligible to get appointed. Please check up with your banks whether these auditors are doing any other job with you. For example, concurrent audit or some other audit which they are doing, they are not eligible to take the statutory audit. Or in other words, a person who is doing the statutory audit is not eligible to take any other assignment for the bank. So those things will be verified by the bank and send the list to the Reserve Bank of India again stating that we have verified all these things. There is no disqualification among the auditors, or there is no person who is doing other jobs with us, etc. Then only the Reserve Bank of India send the list confirmed, yes, you can appoint these auditors. So that is why this process takes some time. That is why it is taking some time, very late in the month of February or first week of March to get, because the process is they have to send original and they have to revisit the conditions, whether fulfilled by the auditors or not. Then they have to resend the revised list to the Reserve Bank of India, and RBI again send this list to the banks, and they have to appoint by placing it to the board. So this process takes some time, 15 to 25 days. Next slide. Next slide. The auditors must state in his report. These are all the 5 information. Each and every report should be there. In addition to what your accounting standard said, what is the other Reserve Bank of India requirement is there, whatever it is, this is our institute says this is an addition to, but this must be there. Whether or not the information that explanation required by him have been found to be satisfactory. That is, should say, what are the information I have seen, what are the explanation they have given me, again my queries, yes, I am satisfied with it. Whether or not the transaction of the company which have come into this notice have been within the powers of the company or bank. Because I told you that Reserve Bank of India gives such and such section. For example, loan to the directors is prohibited. So if any loan to the directors is given, you can say this is not within the powers of the bank. That comes under second category, whether or not the transaction of the company which have come to his notice are being within the powers of the bank. The third is whether or not the returns received from the branch officers of the company have been found adequate for the purpose of audit. Because normally there are branch auditors are there, then statutory central auditors are there. Statutory central auditors finally compile all the audit reports and all the accounts, etc., and certifies the whole balance sheet. So they should say, what are the returns I have received from branches is adequate for us to have an opinion on the accounts prepared at the central office. So for the purpose of getting the return itself is to substantiate his stand on the report, their final report they are going to form it. So the branches sent various returns which are absolutely, for example, the risk-based return is there, then capital adequacy return is there. Unless these returns are compiled and verified, the central auditors cannot certify the capital adequacy of the bank. So these are, we should be satisfied. Yes, I got all the returns which required for me to verify and which required for me to form an opinion about the bank's financial performance. Whether the profit and loss account shows a true balance of profit or loss for the period covered by such account. Here, in fact, the entire profit or loss shown by the bank is correct or not, we should say. In fact, here comes the leakage of income, etc., or expenditure incurred in the earlier year period, debited to profit loss on this year, or any prepaid expenses, etc., not directly charged to profit loss account, or insurance, etc., relevant portion is removed for the next year period, etc. All these comes under this category, and any provision of expenditure which is absolutely necessary has been provided or not. Because when these things are not taken care of, the profit or loss shown certified by the auditor may not be correct. Whether the profit, and similarly, even the NPA provision also comes here part of it, because once the NPA, then interest should not be charged. Suppose the bank is charging interest on NPA accounts also, it has to be removed. If it is not removed, then the section is violated because the profit shown is not correct, because it is overstated to the extent of unpaid interest. Similarly, the provision for NPA accounts, all the provision as required by the Reserve Bank of India is not maintained, the profit shown is overstated to that extent. So because the auditors have to give one more certificate stating that all the Reserve Bank of India norms regarding non-performing assets have been complied with this bank. So that means all the provisions taken care of, whether the unpaid interest is removed or provision for 100%, 12%, 35% has been made or not. Here comes one question, one peculiar question is there. Certain banks, you can see that they are making more provisions than required by the Reserve Bank of India. The Reserve Bank of India says you require 25% on substandard advances. But they say, bank says, no, we may feel that considering the past advances portfolio, sometimes it's substandard advances portfolio is becoming more bad. So we would like to provide more than 25%. We would like to provide 50% of provision. So the minimum provision required is 25. Is correct, right? Then the extra 25% they made, whether the auditor has to qualify this or in this report, the question comes. Because you are certifying that provision has been made as per the Reserve Bank of India norms, etc. So any short provision, definitely you are going to qualify. The excess provision also comes under the state provision, but you should say verbatically that also, stating that the provision has been made as per the Reserve Bank of India's NPM norms. However, in respect of particular advances, the bank has made excess provision as a prudential manner. That you have to mention, because that is also a violation. When somebody says you should make 25%, when I make 50%, no, all right, it is good and on the part of the bank, but it is also a slight violation. So it has to be mentioned in the report, stating that in the case of such and such advances, as Reserve Bank of India's regulation says 25%. However, as a prudential manner, the bank has made 50%. The profit and loss shows a true balance of profit and loss covered by such account. Then any other matter which we consider should be brought to the notice of the shareholders of the company. That you should, because any big violation we have seen. Because what I said in the previous slides about the restriction advances, if it is violated, here the auditor should say any other matter, etc. Similarly, the certain advances apparently may be good presently, but it may require more caution in future because of the something happening in some other area of the same advances, etc. So sometimes what happens is, in the case of consortium advances, where the Reserve Bank of India circular says, if the consortium advances given by the particular bank is all right, so far it is get collected the interest installments, etc., you can show it as a performing assets. But in some other bank, same company's advances is shown as a non-performing assets because of the failure there, multiple banking. What the duties of this bank comes? Because there are two views on this point. One is the bank which has given the advances where the recovery is good, the installment is everything is correct, etc. They will say, my account, it is good. As per RBI norms, everything is correct. So we will classify it as a performing assets. But RBI take a different view, because RBI has got access to all the banks' accounts and find out if any account so classified by one bank is NP advances and the other bank classified this as a performing assets. At the time of annual financial review conducted by the Reserve Bank of India of that particular bank, he will say you bring this account also into the non-performing asset because the other bank has classified this account as a non-performing asset. Still, that controversy goes, it has not reached any solution, but ultimately Reserve Bank's words are final and the bank has to obey. And secondly, what happened is, once the account is classified, because all these things happen after the balance sheet is signed. So next year, the Reserve Bank sent a list of such accounts to the bank stating that these accounts are classified as non-performing assets, though the same has been classified performing by your bank and the auditors. This year, you inform this to the auditors who are coming to the bank for audit. So the bank will give a list of accounts which are classified as non-performing by the Reserve Bank of India in their annual financial inspection report. Even in such case, the auditors has got their own discretion to accept it or not. They can say that, giving with strong evidence, though the account has been classified as non-performing, according to us, this account is only still performing, with giving reasons, etc. They can give it. Because originally, circular issued said that the statutory order should classify. Then subsequently, the matter was taken up by the Institute of Chartered Accountants in India, stating that our stand on this subject is now compelled by the Reserve Bank of India, so we don't have independency on this. Then subsequently modified circular issued by stating that it is the auditors, they put their own views on this subject, but depending upon the circumstances with the evidence, it can be shown. Because I myself had done one account in the case of Tamil Nadu Electricity Board account was classified as performing by the auditors and the board. The accounts were passed. But subsequently, AFA team came and said this account is a non-performing assets. Because the reason is going concern concept is not there. Secondly, the company is incurring losses for the past 3, 4 years, 5 years. Hence, we classify this account as the non-performing assets because the capital is eroded, nothing is there, etc. It's a Tamil Nadu Electricity Board account. Then I have gone through this account and gave another report next year stating that, first of all, going concern concept is applicable to limited companies and the companies. This Tamil Nadu Electricity Board is not a company. It is a part and parcel of Tamil Nadu government. And secondly, their losses are 3 years losses are reimbursed by the Tamil Nadu government later, because first year loss is again audited by the chartered accountants, and it is again audited by the C&AG. C&AG sends a report to the Tamil Nadu Assembly, etc. For this purpose, the Assembly will place it and discuss it and reimburse the loss to the Electricity Board. So this happens in 1/3 years correctly without any omission. So hence, it's a government company. It's a government. It's not even government company. It's government itself. So the profits are being reimbursed. So it is not a non-performing asset. And again, saying, what in the Reserve Bank of circular, if you classify Electricity Board as a non-performing asset, then all the advances given to the Tamil Nadu government is also classified non-asset. Because if one asset is non-performing, then all others of the same person or group of persons should be classified as NPA. That is what RBI says. So then next year it has been removed. So that we have to use our discretion also on this point without sometimes accepting the views of the regulator or any even the board, etc. So this is one example I give that any other matter which considered should be brought to the knowledge of the shareholders. Next. This report is in addition to what our institute, that is a statutory report, what I mentioned, is in addition to what institute says, either in the accounting standards or guidance notes on auditing or standards on auditing, everything is commended this. RBI can also call a report from the auditors like LFIR, report on the implementation committees formed by RBI, capital adequacy, risk-based supervision, etc. Most of the auditors ask sometimes, why you have signed the capital adequacy, risk-based, etc. It is not covered by the act, etc. But you know that RBI has got power to ask any report from any auditors, etc. Because the Regulation Act, Banking Regulation Act gives a special power. Next slide. Next slide, sir. Hello. Next slide, please. One more section is now we come into the Income Tax Act. How income tax affects auditing, auditors, and banking. The 36(1)(7)(a) of the Income Tax Act. The above section gives the privilege of claiming deduction from the taxable income an amount of exceeding 8.5% of the total income and an amount not exceeding 10% of the aggregate average advances made by rural branches of the bank, computed in the prescribed manner. Because the rule 6A is there to how to compute it in respect of any provision made for bad and doubtful debts or made by such bank. Option is allowed sometimes 5% of the NPA advances. As this is additional provision allowed during the period when the government of India relaxed the banks to give identify more NPA accounts, make a provision so that the cleaning of the balance sheet was done. At that time, these additional provisions allowed, subsequently it was withdrawn. But now the 8.5% and 10% that is still there. We can make a avail of this. So while doing the final audit of the bank as a whole, you should consider whether these sections are done or offended. Next. Next. Then these 269 SS and 269 T of the Income Tax Act, which is what special relevance to banks. Section 269 SS stipulates no person can accept a loan or deposit by cash in excess of 20,000 rupees. Banks are exempted from this. Bank can accept any amount as cash. Only thing, if it is more than 50,000 rupees, permanent account number should be mentioned in the challan. The bank should not accept any deposit beyond 50,000 rupees without permanent number. That is the only condition on it. But if everybody submit 2 crore rupees with permanent number, bank can accept. 269 T. No person can repay loan or deposit cash that exceed 20,000 rupees. This section is applicable to banks also. And the auditor has duty bound to report its violation in the tax audit report. So when any deposit repayment, etc., should be first routed through only the SB account, no direct cash. And if it is routed through more than 20,000 rupees, should be issued only in the paper pay order or account credit of some other bank. No cash transaction in this case. Next. Next slide. The Subforce Act. This is a beneficial to the banks. Allows bank and other financial institutions for auctioning commercial or residential properties to recover a loan when the borrower fails to repay the loan amount. Enforcement of security without interruption of court, speed up the recovery process of NPA advances. This is an advantage of the bank. They need not go in the losses of going to various courts for getting their decree applied. So this the Subforce Act gives the permission. See, any person fail to repay the loan or it makes default in repaying the loan, the bank can recall the loan, and if still the loan is not repaid, they can go to the Subforce Act and issue notice on that. And after 45 days, they can even take possession of the house or property, which is security, which is given to the bank. So this only speed up the recovery process. They can auction it and recover the amount and adjust the loan. If the balance is there, they can give it. Only thing is that when you surpass it, court has got both the persons beneficiary, either the borrower as well as the lender. Even the borrower can also approach the court for this purpose and give his objection. This should not be objected, etc. Or he can say, I will pay this amount in an installment or something like that, which the court may or may not agree sometimes. But in the entire process will be over by 180 days. That is only advantages to the bank. Next. Next. So next slide, sir, please. Hello, can you please change? Hello. Right? I think I have told the various relevant sections for the various acts as applicable to auditors. So you now it is any up to you to raise questions on this subject. Hello? 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 Namaste. Hello?
Sir, கேக்குதா?
இப்போ கேட்குது சார். The previous slide கொஞ்சம் போங்க.
அதோ பண்றேன். PPT தெரியுதா சார்?
Previous slide, not in this one. Thank you.
Okay.
The SIRC Act I was expanding. I think the line was cut. It seems now I repeat few sentences of the same. The SIRC Act is a boon to the banks to recover their advances, and it speed up the process of recovery because the entire process should end within a period of 180 days, recovering the advances, selling the property, etc. And the enforcement security without interpretation of court. So they need not go to the steps of various court to get that amount relieved. And the problem is that both the borrower as well lender has got right to appear before the SIRC authorities and vendor their grievances. And the worthy person will. Hello? Right. I think next slide is regarding the IBC. There is a separate section. Next slide. Separate section on insolvency bankruptcy code is there. So I am leaving this chapter to the gentleman who is going to cover this subject. Next. All these things I can, the Reserve Bank of India Act, Section 35, the regulation that gives power to Reserve Bank to conduct inspection to be made by its officers, any banking company and books of accounts. Next. 35, the Bank Regulation Act gives power to RBI to issue directions on banking companies in general to any banking company in particular as it deems fit. And the banking company shall be bound to comply with such directions. So this is the important section by which the Reserve Bank sends various instructions to the banks. So we cannot question the Reserve Bank directly, cannot deal with it because the Act gives power to them. The 35B of the Regulation Act gives power to issue directions to any banking company for resolution of stress charges. Here comes the NPA. All these NPA norms prescribed Reserve Bank of India is only as per this section. Next. Next. In the case of balance sheet, the auditors generally invariably miss these 2 points. Balance sheet value is less than the stock value given by for the bank. For the drawing power has to be reworked and penal interest to be charged if the outstanding balance exceeds the drawing limit. Secured and unsecured portion also to be altered to the extent. So, the practice of getting the different auditors at the same period to avoid it. Normally, what happens is 31st March, before 7th April, they have to give the stock statement. So they give a stock statement signed by one auditor. And as the end of the accounting period, that is before 30th September, the balance sheet signed and they give one more stock. So these two generally varies. So when it varies, the drawing power has to be reworked and the new drawing power is less than the old drawing power, then penal has to be charged. So these are all the highlights I want to give it. And I think I want to close my lecture on this subject because of the time is also over 6 o'clock. I don't want to go beyond 6 o'clock. And any person you want to raise any query, you can raise it. If any interruptions is due to technical error, I mean, sorry.
Guru Prasad Aili has raised his hand. Rilwan, please unmute him so that he can ask his query. Guru Prasad.
Yeah, I gave access to.
Guru Prasad, sir, you can unmute and speak.
He has to unmute.
Guru Prasad. Thank you very much, TRC, sir. There are no queries.
Oh, thank you.
Okay.
The two persons will not have any queries. One person who has understood 100%, the person who has not understood. So those two persons will not have any queries. Thank you. Thank you for giving the opportunity to the institute as well as to the other members and also the participants. Thank you very much.
Thank you very much, sir. Thank you very much. Relevant, please remove Guru Prasad, sir. We have with us the next speaker, Venkatakrishnan, sir. Sir, you can switch on your audio and video, sir. Relevant, am I audible?
Yes, sir. Yes, sir.
Okay. So we are quickly moving on to the next session, that is on insolvency and bankruptcy code. We have with us CAR Venkatakrishnan, sir. Welcome, sir. On behalf of Office of SIRC ICAI, we welcome you for today's meeting. It's my privilege to introduce Venkatakrishnan, sir. He is a fellow member of our institute, having qualified in the year 1982. With a post-qualification diploma in information system audit, certified quality management and systems assessment, and a trained implementer for information security systems. We are certified auditor for verification and implementation of corporate social responsibilities in corporate entities. We are registered valuer, a resolution professional under the Insolvency and Bankruptcy Code 2016. Sir has got a rich professional experience in the industry within the reputed organizations like Pierce Leslie India Limited, Sundaram Clayton Limited, Haritha Finance Limited, holding senior positions in corporate finance and treasury management. In professional practice as a partner of RBKS and Associates, Chartered Accountants since 1991, offering a range of assurance and advisory services for corporates. So as an accredited auditor for quality management systems for leading certification agencies, has led the team for a number of certification, both national and international, and periodical surveillance audits to quality management systems. As qualified quality management and information security management systems professional, having facilitated over 200 companies in their pursuit to establish and obtain certification to international standards. The companies represent a diverse set of industries from manufacturing to services. On the board of a few corporate, advising them on strategic and management issues. He is the past member of managing committee in Madras Management Association, past general council member and treasurer 2013 to 2017, the Indus Entrepreneur Chennai chapter, an occasional columnist with a couple of articles having been published in the Hindu Business Line, an active social media enthusiast on range of topics on management, finance, and public administration. They are Rotarian from 1994 at the Rotary Club of Madras East, and was the president of Rotary Club of Madras East District 3232 during the year 2004 and 5. With this brief, I have great pleasure in presenting before you CAR Venkatakrishnan, sir, to take us through insolvency and bankruptcy code. Over to you, Venkat, sir.
Good evening, my fellow members. Thank you for the opportunity to share some thoughts on the Insolvency and Bankruptcy Code 2016. Having been a resolution professional, insolvency professional, and handling as a resolution professional and a liquidator for a couple of cases, I shall try to bring an attempt to share my practical views on over the last 7 years since the code has been in vogue. One minute.
Your screen is already visible, sir. You have to press the next button.
Yeah, then I am not moving, that's why.
Okay. Press the down arrow or
Seem to be activating.
Relvan, can you help out Venkatakrishnan, sir?
So just click.
Yes, okay.
It's gets
So as you were aware that this code was introduced as a law in May 2016. Then as a response to the growing amount of non-performing assets in the Indian banking industry, which had reached reasonably alarming proportions, and they wanted to find a faster mechanism to resolve these pending insolvency cases or defaults. And the code was came into force effective 1st of December 2016, but currently excludes partnership firms, and the individuals are not covered at this particular point of time, though the laws relating to them has been notified by virtue of a Supreme Court order that individual cases are not to be taken up for resolution till the disposal of a couple of pending applications. So the key issue that we have to bear in mind is that this is a reasonably evolving law and evolving to the extent that even the government is conscious of the fact that it has to bring some changes or amendments to the law, which has happened both by amendment to the act and sometimes even by ordinances. And even within a short span of 7 years, it has already had 11 amendments. So it is evident that the changes are being made pursuant to experiences that many of us are having in the course of the implementation. And as all professionals, we do realize that a significant part of the law comes in for interpretation by our judiciary. And given the time span that we have had to deal with it for it, now we are having a reasonable number of cases being adjudicated by the Supreme Court, not to speak of the NCLAT and the innumerable tribunals that we are having at this particular point of time. So even though the act is about 6 or 7 years old, many of the things by virtue of the amendments to the code as well as the judicial pronouncements from Supreme Court, NCLAT, the National Company Law Appellate Tribunal, the NCLTs, and IBBI's own circulars, notifications, and even the disciplinary orders that has been passed also is giving many of us insolvency professionals a different perspective to the way the code is being interpreted at various points of times. And we are all learning on this on an ongoing basis. For starters, I just thought I'll give you a brief overview of the insolvency bankruptcy code. When there is a default by a company referred in the act as a corporate debtor, so if I use the term corporate debtor, I'm reference to what we would normally in all other circumstances call it as a company. There are three possible situations by which there could be an initiation of corporate insolvency resolution process against a corporate debtor. The first one is called a Section 7 company, which is initiated by a financial creditor if there is a default in excess of 1 crore. Then if so, in the case of a default of a financial debt, and financial debt being referred to as a debt for consideration of time value of money, if there is a default against that, and if it exceeds 1 crore, then it can be a financial creditor can apply to the adjudicating authority for approval of the initiation of CIRP, the corporate insolvency resolution process against a corporate debtor. Now, there are 3 requisites that are required. 1, it should be a financial debt. 2, it should be there should be a default against a financial debt. And 3, it should exceed 1 crore. So, if these 3 conditions are fulfilled, then the adjudicating authority, as per most of the cases, do not have an option but to initiate corporate insolvency resolution process under the Act. The next is where there is a default in respect of an operational creditor. There, any debt that is other than financial creditor, let us, for the limited purposes of our discussions, take it as it will be an operational debt. Though there are some categories of debts which the adjudicating authorities are holding that it is neither in the nature of a financial debt nor in the nature of an operational debt. So, and therefore are not eligible to initiate corporate insolvency resolution process against those companies. Here too, there should be an operational debt, there should be a default, and that should exceed 1 crore of rupees. And the third one is section 10, which is a case wherein the corporate debtor, after passing a special resolution, initiates, the board recommends and the company approves an application being filed by the company itself that there has been a default which is in excess of 1 crore and therefore should be admitted to CIRP. Now, this particular section, though has been in use, has come into limelight in the very recent case wherein Go First initiated application against itself under section 10, stating that it has defaulted in its application, in its debt, even though the banks had classified that as a standard debt. So we are going to see, so these are the 3 broad categories under which, and we maybe this section 10, which I will discuss a little later, may become a strategic tool that the corporates are going to take up to give them some protection against creditor action. And we as professionals need to be cognizant of the fact that this possibility exists and it could have larger ramifications on companies, that the balance sheets that you're auditing, because if a company passes, and even though it is a standard asset, it is not is a standard asset, and in the eyes of the bankers or in the eyes of the non-performing asset, it is possible that somebody is going to initiate this. So this is going to be an interesting situation in the years to come. The one change that happened in 2020 because of the COVID, there was an ordinance to amend section by virtue of insertion of section 10A, which said that any defaults that happen for a period of 1 year from 25th March 2020, which is the date when the government of India notified COVID as a pandemic, that period is a cooling off period and nobody can initiate an application for corporate insolvency resolution process against any corporate debtor. Now, it is not that you cannot initiate any proceedings during that period. If there is a default in this period of 1 year, then the law says that that will not be considered as a default and no action under CIRP can be initiated. Now, this is going to be tested because the promoters of Sri Finance and Infrastructure have challenged the admission of notification by RBI for initiation of CIRP against the NBFC on this ground that it was a default during this cooling period or notified period. So we are going to see some the fair amount of action on that front in the next couple of years. Now, broadly, there has been about 6,500 applications that have been filed initiating accepted. These are accepted applications initiating corporate insolvency resolution process. And you will find that we have these are all data that is published by the IBBI. So these are all available in the IBBI site. So this is for the sake of the discussions. So the source is IBBI. So there's 2,900 cases, applications filed by the financial creditors, 3,265 cases that have been filed by the operational creditors, and 390 cases that has been filed by the corporate debtors themselves. So even though the law, the Insolvency and Bankruptcy Code is not to be intended to be seen as a recovery mechanism against the corporate debtor, you will find that the majority of the cases has been filed by the operational creditors. So this is to a large extent to be also seen as possibly being used as a tool to pressurize corporates, because now this law is based upon the premise that when corporate insolvency resolution is initiated against a company, one of the key aspects is, as against the past where it was the debtor in control, this law is primarily based upon the creditor in control, where an insolvency professional, then referred to as an interim resolution professional or a resolution professional, is given charge of the corporate debtor, and the board is suspended, and all the powers of the board is thereafter vested in the insolvency professional designated as the IRP or the RP. So this has serious repercussions and ramifications for the companies, and therefore it is here the next, if you look at it, out of the cases that have been initiated, that in this period, you'll find that roughly about 264 cases have been closed by appeal review or being settled. Now, another 232 cases have been closed by withdrawal, where the person who makes an application, files an application with the adjudicating authority, requesting that the closure of the application, and therefore that the corporate debtor is given is removed from the rigors of the law. Then you have another 380 cases that is been through closure through an approval of a resolution plan, 927 cases which is by commencement of liquidation, and the balance is still going on. So you'll find that if you go back and see the whole thing, you'll find that if you take the cases initiated by the financial creditors, if you eliminate the 2,000 from the 2,900 cases, 1,100 is still under not been resolved. It's still going on. It's about balances about 2,800. On 2,800, only 380 has gone in through resolution. The balance, more than close to 500, which is in excess of 25% of the cases happens through withdrawals, and a significant portion is going through liquidation. Now, this is something that evidently is found to be disturbing, and that is what we will have to see as what are the implications for all of us as professionals when we are auditing balance sheets of companies or companies that potentially going to have the potential to be admitted to CIRP, or a company that is probably exposed to a company which is potentially going to be admitted to CIRP. So you'll find that even in the case of operational creditors, you'll find that there is a significant percent of that has gone to this thing. But you'll find that, again, you'll find that number of cases that is by appeal, settled or withdrawal, you'll find that close to 1,200, which means in excess of nearly 30%, 33, 1/3 of it, you are going, it is getting settled, which means it's unfortunate that this law is being used as a tool to recover money rather than finding a resolution to this thing. Because today, one operational creditor could settle it, withdraw it, or whatever you want to call it, but it's possible that another person, another operational creditor could file a similar case in a couple of months from now, and the uncertainty that prevails on the corporate debtor and its clients and its ecosystem is going to be very, very strong. So you'll find here in the case of corporate debtors, you'll find 390 cases, only 14 is only by withdrawal or closure, and that is to be expected. But why this is potentially going to be used a lot more is because if the company is admitted to the corporate insolvency resolution process, what will happen is a moratorium will be initiated under Section 14, which will give protection against any action on the company or its assets till either there is a resolution plan or there is a liquidation ordered against the company. Now, therefore, it is possible that we are going to see in the next couple of years that corporates themselves don't see this as a stigma of being admitted to insolvency and use this as a methodology to find an orderly resolution to their insolvency rather than being dragged by sale of assets and other similar actions being initiated against it. Now, some data on the data points on the insofar as cases that have been resolved through resolution plan, you find that against a claim of realization by this claims as a percentage of the liquidation value, the financial creditors have recovered 182.7% of the liquidation value. You bear in mind these data points, which because I will discuss the implications of this for all of us professionals when we are auditing the balance sheets. You'll find, and that represents 34%. Operational creditors have recovered 125.8%, and the corporate debtor self-initiation is 147%. 147% is the liquidation value. As against the claim that is being filed, it is 34.2%, 17.6%, and 18.3%. The average days that has been taken is 613, 632, and 541, which is causing a lot of concern to all the regulators as well as the companies itself, because by law you are expected to resolve this in 180 plus 90, subject to a maximum of another 6330 days. Now, if you look at all the data points, it is far in excess of those periods, that average number of days that is taken, and this is coming in for a fair amount of scrutiny, not to speak of criticism. So there could be potentially some action in the coming time when this is addressed by amendments or through the regulatory process of regulations and notifications. Another interesting facet that you will see in this is the realization in respect of liquidation value as a percentage of claims is only 6.4% in for liquidation and 9.1% for OCs and 8.6%, which is dismal. So obviously what we are seeing is if there is a resolution to the process, the value potential for realization is far higher in the case of resolution plans rather than liquidation. Now, one aspect that we have to bear in mind insofar as these numbers are concerned is in the initial phase, many of these companies that were admitted to CIRP were basically already companies that were NPS for very prolonged period of times, non-functional companies, and so on and so forth. Unfortunately, I also had to deal with a couple of them, and there are hardly any assets in the company. So therefore, it is not surprising that you had liquidation value realized as a percentage of claims being as abyssal as 6.5%, 6.4%, 9%, 9.1%, and 8.6%. Now, this is another data point I would want to show in respect of the resolution companies that were closed through a resolution plan against a total claim of close to 9 lakh crores and a liquidation value of 1,69,000 crores. The recovery through the resolution plan is 2,86,000 crores. Now, again, you will see in that the realization in 2017 and 2018 was very high at 54%, dropped in 2021 and 2021 to 22 to 23, 17 and 23%, and is now gone back to 36%. Now, I would personally like to believe that a significant part of the 2017 to 19 was by virtue of the initial high-profile cases like the Bhushan Steel, the SR, and a couple of other cases which the Reserve Bank of India had initiated action against 12 of those companies, where they were they were operating companies early in this thing, they had good asset background, and therefore the realization was around 54%. Then you see that there is a drop from 2021 and 23, 22, 21, 22, which is 17% and 23%. I believe that this is to an extent attributable to the COVID period where there was a fair amount of distress in the industry across all sectors, and therefore the realizations are pretty bad. Again, 22, 23, it's gone up to 36% of the claims at 51,425 crores. Now, this is therefore, it's possible that we're going to see some better realizations in the times to come on this, because they are a little conscious of the whole process of what, and in the interim, what had also had happened is the perception from the potential resolution applicants was that this could also become a litigant process, and the companies would not be, it would be difficult to take over the companies easily, and there was an element of diffidence in the minds of the investors. Now, with the number of cases both approved by NCLT and agreed by NCLAT and even and confirmed by the Supreme Court, there is a fair amount of increase in the confidence levels of the investors to this regulation, which we believe augurs well with more people wanting to come and take offer resolutions to companies in distress. Now, so what you have to bear in mind in this is there is something called the avoidance applications, more properly more referred to as PUFE transactions, preferential, undervalued, fraudulent, and extortionate, you will find that the amount involved in these cases is about 2,85,000 crores. Now, I would want you to sort of bear in mind that this amount of 2,85,000 crores, I had shown in one of the previous slides that the total admitted claims is 8,98,000 crores, and you will find that though the data set is not similar, but it is substantially not the same, but substantially the same. You will find that in respect of these transactions, roughly about a third of the assets is applications filed under these avoidance transactions, which for us, all of us professionals, is very, very important data point, because you'll find that all this actually, most of it represents fraudulent transactions or a combination of that, or undervalued transactions or preferential transactions. So this has this data point personally for me is got a very significant implication, because this represents the quality of the financial statements of the corporate debtor, and we all have to take into consideration what it forebodes to us professionals on the implications of these numbers at 2,85,000 crores, which represents close to a third of the claims that have been filed. Because you notice here that the liquidation value is only 1,70,000 crores, and even if you factor in that the liquidation value is about 25-30% lower than the fair market value, it still means that the value of the preferential transactions and avoidance transactions is higher than the assets that the company has. Now, this is a data point that all of us professionals have to bear in mind. Now, against this background, I probably would want to share some thoughts on what is the role, implications for a chartered accountant who is the auditor of a company that is potentially a candidate to be admitted to CRP, or what is the role and implications for a CPE of a corporate debtor whose clients or vendors have a potential to be admitted to CRP. This is where I want to bring in the implications of preferential transactions. Now, where the assets of the corporate debtor is transferred to any creditor, guarantor which puts him in a beneficial position, otherwise then he would have been entitled to, if it were to be distributed in accordance with the code, then this transaction can be referred to the adjudicating authority to be set aside. Now, if it is with a related party, it can be set aside. If there's what we call the look back period can be 2 years. If it is a non-related party, the look back period is 1 year. Same way as the undervalued transactions, if it is a related party, it is 2 years. Other related parties is 1 year. Other than any transfers made in the ordinary course of business. Now, this is again, the ordinary course of business is going to be extremely, it is being a debated issue, what is ordinary course and what is not ordinary course. And therefore, it will have a bearing and implications for all of this. And then I'll bring you to the fourth item, which is basically your fraudulent transactions. And this could have bearing on all of us professionals in the times to come, because section 66(1) says, if the business of the corporate debtor has been carried on with the intent to defraud creditors of the CD or for any fraudulent purpose, the adjudicating authority may, on application of the RP, pass an order that any person who were knowingly parties to carrying on business could be asked to contribute to the asset. Now, as I told you earlier, this is still, the law is a very nascent law. We don't know how this any person could be interpreted. Now, that has significant implications on all of us as professionals, because this could be used as a class action suit against the company, the directors, and maybe even the auditors. Now, this is something that we cannot lose sight of. We have to bear in mind that this there, and the extortionate credit transactions, as I said, it is where the CD was required to make exorbitant payments in respect of credit provided. This is usurious transactions, credits. Now, you would have noticed that in this, actually, the number of cases filed in this itself is not so high. You'll find that extortionate credits itself, the amount involved is only 71 crores. So you'll find that this is not come under too much of a scrutiny, but nonetheless, it's a reference point. But I would personally look at, from us professionals, I would say that the application under section 66(1) has a far higher bearing, and 66(2) also, which has a bearing only on the directors who knowing that the company was insolvent, carried on business, then they could be held responsibly accountable in their personal capacities. So if you ask me the pecking order in terms of the implications, I will say 66, because for fraudulent transactions, there is no look back period. If you notice, for preferential transactions and undervalued transactions, there is a look back period of 2 years for the promoters and one related parties, and for non-related parties, it is 1 year. But if the transaction is fraudulent, then there is no look back period, and you can go back practically even up to the inception, from the inception of the company, which is happening in a couple of cases. So the ramifications of this is reasonably high, and we have to bear in mind what the implications are. Now, what is the implications to a professional who is the auditor of a company that has defaulted and has potentially capable of being admitted into CIRP? You could get exposed, because if the transactions under 43, 45, 50, and as I said, 66 has a fair amount of implications on all of us, because it's going to be a matter of time before somebody asks, saying, how did the balance sheet, and if you go look at the claims amount, as I said, in excess of 30% was assets represented by transactions with related parties. How was it permitted? Now, that could be a very serious question that is being posed, and this is something that we will find it difficult to deal with in the times to come. Now, what about the financial statements? Now, appropriate provisions have to be made. Now, as I said, you will have to, what are the implications of, now, if suppose the balance sheet of 31st March 2023 is there, now how would you deal with the balance sheet of 31st March 2023 if the company got admitted to a corporate insolvency resolution process post the year end? And therefore, what will be the implications? What is the fair market value? What is the overstatement or understatement of profits or liabilities, or understatement of liabilities? Now, see, one of the aspects that I wanted to bring to the attention of the members is, as I mentioned, there was close to 9 lakh crores of claims that have been admitted against the company, whereas the fair market value of the assets, assuming was 2,25,000 crores, assuming that the liquidation value is 1,70,000 crores, which means A, that the assets have been grossly understated. B, the liabilities have been grossly, assets have been overstated. liabilities have been understated, or there is a very high degree of off-balance sheet items or contingent liabilities which have not been accounted for or appropriately notified in the book, in the notes and accounts and other aspects. So this is something that which will have very, very serious implications for all of us. So my submission to my fellow colleagues is that we have to be extremely careful, especially in respect of companies that are have a are, like for instance, either they are already a non-performing asset, or they are in SMA 2 category, or there has been significant defaults in their commitments. So these are all issues that will come, and therefore you will have to look at the assets from a larger perspective. Now, the third bucket of concern that you have to look at is the related party transactions, which has an implications under the avoidance transaction that I'm referring to. The related party definition as defined in section 524 of the Insolvency and Bankruptcy Code and the Accounting Standard 18 and section 276 of the Companies Act, you will find that there are very subtle differences that are there, which the ramifications and the scope is wider, and therefore it is becoming incumbent upon us to start looking and saying, should we use a very straitjacketed definition of a related party insofar as these transactions are concerned, or would you want to look at it from a wider perspective, especially if there is a potential for a default from this company? So these are aspects that we, as professionals, we have to bear in mind. Now, same way, what about implications in respect of companies that your client has an exposure to? Either the customer is a potential candidate to be admitted to a CIRP, or a vendor to whom significant advances have been given for the purposes of supplies. Now, that has a material bearing. So therefore, it becomes a very strange situation where it may not be out of place to start monitoring the cost list of both the NCLT and NCLAT at the register in the jurisdiction of the NCLT, where the registered office of the company is located, to see whether notices under section 8, 7, 9 or 10 are pending before this thing, and which means they are potential candidates for CIRP. So in that case, you have to ensure in some cases the resolution plan or liquidation is ordered immediately after that. What is the provision that you have to make in the books, and other similar aspects that we have to factor in the whole process. Now, you have to check whether the client has preferred a claim for inclusion as creditors with the insolvency resolute professional IRP or RP, or if in the case of liquidator, liquidator. Because, and then if it is in liquidation, if you go by the data points, you will see that the prospects for recovery is relatively low. No, so these are things that we have to bear in mind and look at these aspects that, from a perspective of auditing the balance sheet of a company that is potentially has the prospect of being admitted to CIRP, or a company which has dues from a fair amount of dues from companies that have been admitted or run the risk. And my experience has shown that many of the claims, unfortunately, we can be sympathetic to that, but unfortunately we have a professional role to play. They have a very high concentration risk on these companies. Many of the SMEs have a very high degree of concentration risk, where a significant part, sometimes as high as 75, 80% or 90% of the turnover and receivables are due from companies that are potentially going to be admitted to this thing. So especially in those type of cases, the materiality could be significantly different from for assessing the materiality risks that we are required to do. So you may have to revisit some of these in the times to come. So as I said, the implications on the difference between section 524, which is the related party, and 524A, which is the relative, is, in my opinion, of a far wider import than what we see in section 276 of the Companies Act. So if you were to take a conservative and comprehensive view of the exposures, especially with companies, I would imagine that the right definition would be section 524, and I suspect that they will, in a matter of time, align both 276 and section 524 and 524A as they'll align both of them, so that we don't have this situation where this multiple interpretations are taken on that. Now, friends, this code is an evolving code. This is a fair amount of action is possible in this. We are going to see the cases where the as a section 10 cases where self-admission is going to come, and we are going to see many of those SMEs are going to go into this, where we potentially will be seeing a lot of that in the times to come. I'm happy to share with you any specific queries that I have, because I personally think this is more a discussion based law than something that I can explain this code from a different perspectives based upon experience. So we are going to see a lot of more action in what we call the pre-packs, what they call is pre-packaged insolvency resolution process, PRIPS, which is currently restricted to SME companies. Now we may see that being extended to all other corporates. That has been in the discussion in the forums. I'm happy to answer a couple of questions before the next session starts.
Sir, have you answered some of the questions in Q&A? There are two questions. Shall I read it?
I'll just go now.
Shall I read it for you?
No. Sumana, default exceeding 1 crore is for a single creditor or is for a group of creditors? The law is, at this particular point of time, is a single creditor. It is not for a group of creditor, except if you were to the creditor assigns it to you. It has not happened. Consolidation of debts is as a matter of fact, it's an interesting proposition that is going to happen, where somebody buys the debts of others and then consolidates all of them to exceed 1 crore assignment of debt, if your contract provides that you can assign the debt. Now, if the many people have discounted bills of the same company, the discounter will become will be a holder in due course in respect of all the receivables, and therefore it could be more than 1 crore will be definitely be taken for the purposes of default. Now, preferential transactions and undervalued transactions essentially are such of those transactions where you have given preference. Now, to suppose I sell an asset to a related party at a price in the which is not necessarily the fair market value in the last 1 year or the last 2 years to an unrelated 1 year to an unrelated party and 2 years to then this could be seen as a preferential transaction to alienate those assets for the limited purposes of keeping it away from the creditors. And now you have the Supreme Court judgment in the case of JP Infratech, where they held that where the holding company had extended guarantees to its or based on its assets to its subsidiary companies based upon land banks that the company had, the Supreme Court held that those were treated as preferential transactions and it was restored. And you'll find that this 5,500 crores that I noticed about, I showed you, was as part of this one only. So that is also part of this same bucket. Have I answered your question, Sumina? Unrevealed transaction is basically where you are where the transaction has been transferred for the purposes of a consideration lower than the fair market value, with again a fraudulent intent to keep the assets away from the creditors.
That's it, sir. So thank you very much, Venkatakrishnan sir, for elaborately taking us through the insolvency and bankruptcy program. Thank you very much.
Thank you very much.
We are quickly moving to the next session. We have with us CA Sivaraman V. Welcome you, sir, on behalf of SIRC ICAI and on behalf of Revati Raghunathan, madam. We welcome you for today's session on labor laws. It's my privilege to introduce Sivaraman, sir. CA Sivaraman is an associate director in ASA and Associates LLP, Assurance Division, Chennai. He is a chartered accountant with over 12 years of post-qualification experience. He is a graduate in commerce as well and information system auditor. Further, he holds post-qualification certificate of ICAI in International Financial Reporting Standards on Business Responsibility, Sustainability Reporting, and he is a certified as a social auditor by NISM. He has experience in servicing large and medium-sized clients engaged in the industries of banking, financial institutions, manufacturing, trading, services, and construction and development in the areas of statutory and tax audit. Limited reviews apart from advising clients on strategies for governance, restructuring, Indian accounting standards conversion, business responsibility and sustainability reporting, assurance services related to IPO, etc. He is also a member of an online panel of experts to address queries related to statutory audit constituted by Auditing and Assurance Standards Board of ICAI. With this brief, I have a great pleasure in welcoming CA Sivaraman V to handle today's session, this session on labor laws. Over to you, Sivaraman, sir.
Thank you, Rahman, for this warm introduction. Can you please confirm I am loud and clear? My everything is perfect. Sure. Thank you. And just I will share my screen. You please confirm whether my screen is visible.
Yeah.
Whether the presentation is
visible, sir.
It is
Fiscal
visible.
program and other laws, labor laws, audit consideration.
Audit consideration. Yes.
Thank
Fine.
you.
Yeah. Thank you, Rahman, for this warm introduction, and I thank entire team of SIRC for giving me this opportunity to share my thoughts on labor law related audit consideration. Okay. So, and I thank all participants for logging in this session, and wishing you a great evening. See, today we will be discussing on audit considerations with respect to labor law. If you see, generally the labor component or labor cost is a significant component in any manufacturing entity, and it not only restricts with manufacturing entity, it goes into service, and irrespective of its size, when we take any balance sheet. So if you have to run any organization, the labor cost or employee cost is unavoidable. It is very much there in almost all balance sheet, and it is not a trivial component to ignore also. So that way it has a materiality, and as auditor you have to do certain procedure with respect to employee cost, and as an entity or entrepreneur, whoever is running the organization also should have sufficient team to take care of labor law related compliances. So so having fundamental knowledge on labor law hence is necessary. So we will be, again, the labor law is, there is no single law which will cover entire labor related aspects. So we have multiple laws. So in this session we will be covering critical few laws which will be there in almost all balance sheet or substantially all balance sheet. So we will be going through the list of laws, and then what is the key compliance requirement with respect to those laws, that will be discussed in the session. And then what is the accounting aspects, auditing aspects, disclosure requirement in the financial statements, and the reporting requirement. If you are auditor, as auditor, you are expected to take care of certain things that we will be discussing. And in terms of quality review board or financial reporting review board, so the reviewers would have reviewed and they would have published on a yearly basis. They are giving their quality review board is giving their observation on a yearly basis. So I have compiled the observations with respect to the labor law related matters, so that we will be discussing. So this will be helpful for both as a preparer to ensure that they are in compliance with respect to the reporting, as well as for the auditor to ensure that the financial statement that they attest and their report are in compliance with the regulatory requirement. So again, as I said, there are so many laws, around 20 plus laws are there. Just as an thing to, as a process to consolidate everything, the labor law, new labor laws and the codes have been introduced. The drafts are released, but it is yet to be notified. So as on date, what is relevant is the existing laws only. These laws are yet to be notified, the effective dates. So we will be discussing on the laws that are applicable as of today. So as I said, the laws that we are seeing on the screen, PF Act, ESI Act, Bonus Act, and the Gratuity Act, I felt these are all the major 4 acts which will have a implication in almost all entities and all financial statement. So we will be spending some time on this and the presentation and disclosure with respect to this, and few practical queries that we have received during the course of our assignments, and which we hear from our friends. Those things also I have compiled, so that we will be discussing those points also. So this is with respect to PF and ESI Act. The first thing is on applicability. So again, so here I am giving you just, but these points are the points to be taken in mind when we ensure or when we try to have some assurance on compliance related matters. So the acts generally says it is applicable to every factory and other establishment. So when we decide, when we think about the applicability, we have to be very careful on this definition. Employing 20 or more in case of PF and 10 or more in case of ESI. So that is the employee count that we have to keep in mind. And it includes the contract employees and apprentices other than those covered under Apprentice Act 1961. Here, the interesting case, actually in many cases, knowingly or unknowingly, employees are recruited, or the staffs are labor force is recruited as apprentice for a limited period of time to avoid compliance aspects, as well as to have more cash flow, because if they are apprentice, generally they say there is no requirement of PF, ESI and all those things. So whatever, employee also more happy because they are getting the cash without major deductions. And for company also, it is saving lot of time and efforts on compliance and their part of contribution. So they are trying to term the employees as apprentice. So that is not so easy as many entities think. Apprentice, there is an act 1961, the Apprentice Act. The apprentice should be those person who is undergoing training in the designated trade, and he is due to a contract of apprenticeship. So all these things are mandatory. Simply, I cannot say just to avoid the compliance requirement, these people are apprentice and accordingly I will not ensure compliance. So when we exclude some people from the applicability of that, we have to ensure that they are fitting within the definition of apprentice as per the Apprentice Act. This is the very critical thing, even in terms of what you can say, Payment of Bonus Act and the Gratuity Act also, when the companies are sending details or when they are planning to do compliance, they are excluding apprentice. That can be excluded. The apprentices can be excluded provided they are covered in the act. Again, designated trade is defined. It may be any trade or occupation or in any subject, whether engineering or non-engineering, technological, vocational, all those things are okay, which the central government, after consultation with the Central Articleship Council, Apprenticeship Council, may by notification in official gazette specify this as a designated trade. So all these compliance have to be taken care, then only we can exclude those apprentices. So that is one thing. And the employees who will be, see, first thing is the number of employee. If the employee count is crossing 20 or 10, then the compliance needs to be ensured. Then of the total employee, for how many employees you have to deduct, remit, and other compliances needs to be done. So for that, the employee is getting wages up to 15,000 in case of PF and 21,000 in case of ESI are to be mandatorily covered. For other employee with respect to PF, you can do opt out. There are certain procedure, because I am keeping here again the definition of wage is different in each and every act. So we have to be careful with respect to the components that has been considered for wage for applying respective percentages. So that is also one thing. And as on date, this is the amounts. The amounts also keep on changing. So we have to have an eye on the amounts also. Again, so the employee count of 20 or 10 needs to be checked only for registration purpose. So once the applicability comes and you are into the compliance, then the continuous compliance is required, irrespective of whether the number of employees are 20 or 10, as the case may be in case of PF or ESI. For example, if the employees count is coming down to 15, so just because now the employee has fallen below 50, I cannot say that is not applicable. Once it is applicable, then it is applicable forever. Even if you are having 1 or 2 employees, still the compliance needs to be done with respect to those employees. So that is with respect to the applicability. It is applicable to contract employees also. We have to be ensured when we make the payment to contract, because in established industries, the people are ensuring those employee you depute to me should have proper PF registration, and you have to produce us the copy of PF payment. Then only the portion attributable to PF will be released. So the principal employer, the companies are taking care up to that extent to obtain copy of PF challan of the contractor. So it will save them in future from the non-compliances related questions, if any, from the authorities. So that is mainly with respect to applicability, which I thought it is a little critical to take a note of. And then the monthly contribution, the employer contribution has to be paid out of their cost, and employee contribution has to be reduced from the salary and to be remitted. And the return those compliances, and we have to ensure that the payments are made within due date to avoid interest and penalty at a later date. So these are all the quick critical compliance requirement with respect to PF and ESI Act. So next comes the payment of bonus act. So here again the applicability, it says every factory and other establishment which are having 20 employee or more. So whatever we discussed in the previous thing also will come here. So I'm not repeating. Once it is applicable forever. Subsequent reduction will not save the company from not applying the provisions of this act. That is the thing. And the employees earning wages up to 21,000 are covered as employee as far as the payment of bonus act is concerned. So to get eligible for this bonus, it is sufficient that if the employee has worked for not less than 30 days. So if they have worked for 30 days or more, then on the yearly salary, you have to pay minimum 8.33%. There is a computation for bonus that we will be discussing little down the line. But if the employee has worked for not less than 30 days, those employees are eligible for bonus. So the fourth point we have already discussed, if the number has come down below 20 also, you have to continue to comply with the act, because once it is applied, it will continue. Second is the minimum bonus. So as per the act, even in the years of insufficient profit or no profit, the minimum bonus of 8.33% has to be paid on the salary. That is the thing. And sometimes the industry may be having some fluctuations, and to ensure that there is a constant amount of minimum 8.33 is paid, they have this minimum bonus concept, and it is having a cap also. Maximum you should have. Even in the year of profit, the companies are asked to restrict the bonus up to 20%. So again, there can be cases where you would have paid bonus even in the years of insufficient profits, and you would have restricted the bonus to 20% where you have earned actually more profits also. So to have a equalization thing, you have to compute what the available surplus, allocable surplus. There is a computation available in the act. It is so clear. There will not be any what you can say. There will not be any complexity in applying the act with respect provisions of that with respect to this computation. The point to keep in mind is there is a initial period of 5 years that we will come to later, assuming that the company is there for 8 years or more. So for the routine companies, if I have paid bonus without having adequate profits, then I will carry off this loss and I will set off in the future in which I am having more profit. So this set off and set on, if I have paid more, then whatever is excess, I will be over and about 20% of bonus excess profit I will be carrying, and that will be used for the year in which I am having loss. So this set off and set off can happen for a period of 4 years. So that is the time limit they have given, and whether any deduction is possible from the bonus. So if it is a statutory bonus, statutory minimum bonus we are discussing about. If the company has a practice of paying bonus on Diwali time or Pongal time or whatever is the festival they have. So during festival bonus or as a customary, they used to pay on their founders day or whatever it is. So whatever is paid, that whatever is already paid to the employee can be reduced out of the minimum bonus or whatever is the bonus that has been computed, and balance can be paid, that you can set off. Or you have a cases of financial loss caused by an employee due to the misconduct of the employee. You can clearly identify that he has done it intentionally. Then even in that case, whatever is the financial loss, if it is quantifiable, that can be reduced from the bonus that has to be paid to the employee. And then this is the cases of new establishment, because the company on the year of incorporation and in subsequent further period, there will not be sufficient profit to make the, there may or may not be. So from the year on which the company is start doing business, actually real purchase, sales, rendering of service, and all those things are happening, and the company starts earning profit. From that year onwards, for the next 5 years, they can compute profit, and whatever is the profit they can pay. So if there is a profit which is below the minimum bonus, you have to pay minimum bonus. So it is up to that level for first 5 years from the year in which you are making profit. So from the 6th year, on the fifth year, you will be computing the bonus and making payment, and you will have the set on set. You will have the surplus or shortfall to be carried forward for next year. So when we do the next year, 6th year accounting, after profit 6th year accounting, the normal bonus computation will be performed, and you can do set on set off for 5th year and 6th year alone. Similarly, for 7th year, you can do 6th, 7th, 6th, and 5th. From 8th year onwards, it will be normal, because you will have this carry forward only for 4 years. So 8th and 9th year onwards, there is a normal computation. There is no specific treatment required. So again, these are all the things, because in every act, there are n number of case laws and other things are there. These are all by default, we have to keep in mind, and based on our experience also, there are many companies who are not maintaining the set on set off working, but it is a requirement of the act. We should ensure that the companies are doing it and compute it, assess the impact, and it has to be informed to the appropriate authority to ensure that the compliance is put in place at the earliest possible time. So this is with respect to Payment of Bonus Act. And then comes the Gratuity Act. So again, the applicability, every factory and other establishment. So it runs into 2-3 lines, but by and large, almost everything, every organization, every shop or every entity is covered here. So that is what it is. And the number of employee is 10 or more. If the organization has 10 or more employee, then the Payment of Gratuity Act is applicable to that organization. So that is with respect to, and the second point is common for all 4 laws. Once the employee count has crossed 4, irrespective of the fact that whether it is maintained at same level or it is falling down below 10, the compliance needs to be ensured. So that is the second point. And the eligibility to get gratuity from the company is not less than 5 years of 5 continuous years of service. So in between, if you have a break, then that will not be considered. Only continuous period of 5 years service is mandatory. And here also the break has happened because of what reason, that needs to be kept in mind. There are some exemptions given, but generally in a normal scenario, to receive the gratuity, you should be worked with the organization for a continuous period of 5 years. So here I am making it so clear, or I want to iterate that this 5 years of service is only to ensure that the payment is paid after completion of service or after the event happens, the gratuity is paid. But the accrual of liability has to happen from year 1. That we will discuss little later, because people, some entities are having a view that the liability itself will be accrued after 5th year. For example, if an employee is leaving in 6th year, I will have to make payment for all 6 years, not only for the 6th year. So the liability has to be accrued from year one that we will be discussing in detail in the subsequent slides when we discuss about actuarial valuation and other things. And there is a maximum threshold given for gratuity, that is 20 lakh as of now. Now that, as I discussed, you have to pay gratuity to the eligible employees. For that, you have to accrue provision year-on-year basis. There is no statutory requirement to fund the liability with any organization. Maybe generally LIC is doing, LIC or any other insurer who is doing this service. It is not mandatory, but it is advisable after crossing a limit where the number of employees are more and you have crossed the 5th year at least. It is better to start funding so that there will not be any cash flow issues when the employees are leaving and when the company needs to make the payment. So it can yearly make the payment so that the fund flow will not be affected. So that is with respect to gratuity. So now we are coming to the accounting aspects. Okay, so with respect to PF and DSI, I'm not seeing any major challenge except for a few cases. In respect of accounting, employee contribution needs to be reduced from salary. So when you make the salary entry, it will sit in a liability. When you make payment, it will be squared off. Similarly, with respect to employer contribution, and there are some charges mentioned because it is a state, generally it will be run by a state and you have to pay some accounts maintenance charges and other thing. So both employer contribution and account maintenance charges are expenses to the company that has to be debited to the profit and loss account. And you have to have a corresponding liability. Both needs to be settled. We have to be careful when the salary packages are negotiated on cost to company basis. When it is done on CTC basis, generally companies will factor employer contribution that they have to pay also as a cost to the company. So when maybe it is okay to have it at the discussion level when the letters are actually issued to the employee after reducing the employer contribution only to be disclosed officially as a salary. Then only the balance portion of employer contribution can be paid by the company by debiting P&L. So again, the income tax and everybody is saying, if again, in case of some cases where the employees are not interested or they do not want any deduction, they are asking my total cost will be say 10,000 or 12,000 or whatever it is. So don't deduct anything. You give me fully, I will take care of my future savings and other things. So in few cases, then the employees on their own, they are making remittance of both employer contribution as well as employee contribution. This working you have to do in case of TDS where the other person is saying, I want to have net tax. So we used to do gross up and make payment. Similarly, with respect to employer and employee contribution, we cannot ask the business to do it in a way the act is defined. Business can happen in its way, but when you decide on CTC and other things, you have to ensure that the employee is getting whatever is agreed between the company and the organization. Employee is getting whatever is agreed between him and the organization, and the compliance with respect to the acts are also taken care. So similarly, you have to accordingly you have to back work and work on what is his expectation, what should be the employee contribution on that, and on top of it, you should fix the CTC so that his portion is saved and the company can contribute employer contribution. So when the pay terms are negotiated and documented, we have to ensure that the statutory compliances also will be ensured on this. Again, the payment of bonus act, if the adequate, first you have to ensure that the appropriate amounts is computed, whatever needs to be paid. And if it is not paid within the year, bonus provision has to be made. That is the thing we have to ensure. As the accounting aspect, if it is paid, then it is a normal payment entry. If it is not paid, we have to ensure that the provisions are created. Then comes the gratuity. So here there is a real concern. That is what we were discussed in brief in the previous slide also. For all eligible employee, the liability has to be accrued. Okay, so this accrual has to happen as per AS 5 or Ind AS 19 as the case may be. If both are not applicable, it is a very small entity not covered under accounting standard or Ind AS 9 also, then they can do their estimation and provide for liability to ensure that the true and fair view of financial statement is ensured. But by and large, the members that we do audit will include the entities for which accounting standards are applicable and Ind AS 19 is applicable also. We have to ensure that all eligible employees list are given to actuary and the liability needs to be actually determined, because the liability what determine is the cost of the undertaking, not for individual employee. So they will be getting input of all employee, and they will get the data of early increment, attrition rate, and based on the actuarial assumptions, they will arrive at the liability for the organization. So that needs to be completed. We have seen only those employee who have crossed 5 years, those lists have been shared. That is not the case. You have to give all employee, because the payment may happen in the 6th year, but the relevant services have been rendered from year 1 onwards. So the matching concept of income and expense has to happen. So anyhow, for the income tax, it is totally different. We will be discussing that little later. But to show true and fair view also, for all applicable employee, the liability needs to be estimated. So it has to be done on an actuarial basis. Projected unit credit method is the method prescribed as per the standard. So we will be getting it from the actuary. He's a management expert. We have to follow the procedures which are applicable when we use, as auditor, use the management expert. So that is with respect to gratuity. You have to determine the liability and account for it. Again, you have some disclosure requirement that we will be discussing in the subsequent slide. So as far as accounting is concerned, the liability needs to be estimated and accounted. Then comes general. So with respect to any act, knowingly or unknowingly, there can be some non-compliances which we may feel that it may not be triggering, and it will not be known to the regulator, or it can be some what you can say, it might have missed also, because even the contract employees needs to be covered in your PF and DSI thing. So there can be cases of unintentional errors also. So the moment there is a trigger, it may be an internal trigger or external trigger also. Internal trigger from your own employee identifying and informing that there is a possibility that we may have to pay in future, or maybe out of internal audit observation, or maybe out of a notice, show cause notice, or some audit inspection preliminary observation. The source can be anything. The key point here is the moment we are aware that there is some liability, there is a potential liability that has to be critically evaluated, if required, with the help of external expert also. And you have to determine what is the probability that it will be paid. So if it is a sure liability, then it has to be provided for, because in many cases the clients are arguing it is just our estimation. No one is aware, the authority is not aware of it. So that is also not acceptable. And in some cases we have just received show cause notice, we have not yet received demand. So these things are not necessary to create a provision. If there is a liability as per that, the amount needs to be paid, then the provision has to be created. Again, presentation and disclosure. If there can be the other cases also, the company will be fully in compliance with the regulatory requirement, but the authority will have different view and they will be giving you a demand. So if the demand is received, then you will have to do again same your own diligence, and if required, you may take a help of external expert and decide what is the probability that we have to make the payment. If there is no probability, it is a clear case, and even if the authority is not agreeing, we will go for an appeal, and at that level we are confident of winning. In that case, disclosure is required, because if a demand is raised, it is a claims against the company, not acknowledged as a debt. So adequate disclosure in the notes on accounts is mandatory. So with respect to this labor law, we will have your accounting aspects as well as presentation and disclosure is also required. Here we are more concerned about provision. So don't wait for any demand to come. If there is a non-compliance with the law, the liability needs to be remitted, adequate provision has to be carried in books. That is the thing we are discussing as a general thing. So now we will be discussing on auditing aspect as auditor, mainly as a statutory auditor or internal auditor also. So what are all the procedures you will be doing? So you have to obtain the list of labor laws applicable to the client. That is the starting point. And then I have to understand, because the compliance responsibility is that of the entity client. So we have to what is the system, process and controls in place to ensure that they are in compliant with the labor law provision. So whether they have any checklist that has been, how frequently the checklist is updated for each and every compliance. The other thing is how frequently the checklist is reviewed for its relevance. There can be amendment from the amendment in the respective law, which is previously 21,000, maybe increased to 30 or 31,000 also. There has to be a fixed time frame within which your checklist will be reviewed, and on a monthly basis, because many acts has, your PF ESI acts has the collection, deductions and remittance to be made on a monthly basis and returns to be filed on a monthly basis. So on a monthly basis, what are all the checklists are prepared, and who is preparing the working, who is reviewing the working, and who is authorized to make the payments. So those things have to be looked into, and you have to do the review of reconciliation between the books, returns filed with the authorities, and the payments, whether all these three things are tying up. Now we have to keep in mind, it is not only the returns filed to the respective authority and books. There can be similar information shared in some other places also. For example, if you see in case of top 1000 listed company, the business responsibility and sustainability reporting is mandatory. It is asking, it is mainly ESG reporting that is presently applicable in India. ESG is employee environment, society, and social and governance related matter. So employee related information also, there is a lot of information that every organization needs to, meaning the applicable organization, those entities who are top 1000 listed company, they have to produce. So the information which you publish in various places should reconcile. It should agree. If there are valid reason, then it needs to be properly reconciled, and it should be ready for the auditors to review. And in case of any external reviewer asking also, the company should be in a position to produce those information. And we have to see the history of past payment of interest and penalty. This will give an idea of where the company is lagging or missing on the compliance part. So whether those things have been set right in the current year, that can be reviewed. Then comes the communication from authority and company's response to the same, any notice or inspection report or demand raised by the company, and what is the response in with respect to the communication that we have to go through. And internal audit, because internal audit will do a really supportive job in statutory audit, because the internal audit will do more of process understanding, and they will bring out many critical observation which will be useful to the auditor also, and for the company also, to ensure that they are not getting into any major non-compliances and any significant demand or raised by the authorities at a later point in time. So the internal audit report, review of internal audit report with respect to the HR process or labor law, that will help in understanding the compliance status of the company and to decide our audit procedures. So then comes the audit report and the CARO report of yearly year. In case of any dues or any amount for which the provision needs to be created, but the company has not created. If the amount is substantial, then there will be qualification in the audit report. There necessarily need not be a qualification. The company may be fully compliant, but if the status of pending legal cases is so significant and the auditor has spent substantial time and effort in that, this will find a place in report under key audit matter in case of listed company. So we will get to know. So that is the major significant component in the financial statement. Then you can plan your audit accordingly. So that is with respect to audit. And the CARO, we have 3 reporting with respect to the labor laws, PF, ESI laws, whether the company is regular in making the payment. That is one reporting auditor needs to give in CARO. And if there are any dues outstanding, then the list, the undisputed outstanding dues with respect to PF, there are many acts covered, but I am restricting it to PF, ESI, which are outstanding for a period more than 6 months from the date they become payable. So there, if there are any reporting, then we will get to know that yes, the company is having a past record of not making payment on time. So whether the same has been set right in this year, or whether still the same trend is continuing. So that is a thing that will provide some insights on the company's past track record with respect to statutory dues payment. And in case of ongoing cases in PF or ESI, it is better to get an opinion from the counsel who is appearing before authority, or from an independent person if the company is appearing on their own and submitting the data, because it is always to have better considering, again, you have to take a call considering the amount involved, materiality and all those things. If it is significant, it is better to get an independent opinion and decide whether even at the notice stage alone, it is not only with respect to ongoing cases, whatever is the internal trigger that has happened, that I am saying because of your internal team's identification or internal audit report or show cause notice, whatever it is, the moment there is a issue with respect to non-compliance, it is better to evaluate exactly what is the position and pass necessary entries. That is the thing. So for that, we may have to get an opinion from the legal counsel or external expert and evaluate the same. So that is a key audit aspect that we have to do. And as I said, the actuary, the gratuity, though the payment of gratuity act doesn't require the actuarial valuation as per the accounting standard and Ind AS, actuarial valuation is mandatory. So we have to do procedure which are applicable as per standards on auditing in case of the auditor relying on management experts. So we have to ensure whether he is a certified actuary, whether he is having necessary professional qualification, and we will do a general web search regarding him, whether he is a reputed person and there are no negative remark with respect to his valuation and other thing. And necessarily data sent to actuary you have to verify, because as I told, the company, some companies are practicing only those employee who have crossed 5 years, only those people are, those list is sent to actuary. Some companies, these people are trainee. So simply trainee or apprentice, you cannot exclude. You have to ensure whether he is a trainee or is apprentice as per the Apprenticeship Act. So whether the data is complete, accurate, that you have to send review, and the assumptions used, because if there is any error in assumption, then the value that you get will be different. So the input you have to ensure whether, again, in many cases we are seeing the attrition rate that the actuary takes may not exactly match with the attrition rate of the company, because even that cases where we have a significant variance, we used to have a call with the actuary also. So the actuary's response is like, it is a futuristic valuation. So when you do a futuristic thing, you should not stick on only to the performance and other things of your company. You have to benchmark it with the industry standards. So they are saying within the industry standard, this is the attrition rate they have, and this is the overall basis. Maybe in 1 year you will have huge hike, but salary escalation rate on an ongoing basis, it will not be the same. So whatever is the explanation of actuary, we have to document, we have to prepare a minutes of meeting with actuary to evaluate the assumptions if it is not within the range, and you have to document those things also. And if it's the funded, the actuary liability is funded by the entity, fund statement also we have to verify, which the company will obtain from LIC or some other fund manager with whom they have a fund, and it will be remitted, it will be issued to actuary, because the liability that will be taken in book will be net between present value of obligation and fair value of plan asset. So the present value of obligation will be determined by the actuary based on the data that has been sent by the company, which is validated and confirmed by us. The fair value of plan asset, that is purely based on what is the information information that is produced by the received and produced to the actuary by company. So we have to ensure that it is as of March and there are no error, because some companies are obtaining on a monthly January, February statements have also been issued. So we have to ensure that the time gap between these two are not material, and to a greater extent, it is better to have as of the year end only. So that is largely the auditing aspects. Then disclosure in financial statements. So the first thing is accounting policy with respect to PF, ESI, and gratuity. So all those things, the like for audit firms, SQC1 is a very critical thing. Similarly, for the financial statement, accounting policies are very critical. So each and every number in the financial statement will be understood based on your accounting policy. So substantial time and efforts are necessary to validate or to draft the accounting policy. So because there are some observation coming out of this accounting policy, error in drafting accounting policy also, that I will discuss when I come to that thing. So whether your policy with respect to your PF and other ESI and your gratuity, all those things are defined contribution plan or defined benefit plan, and in respect of defined contribution, whether you are making payment to the trust administered by the entity or to a state PF fund, or what you are doing with respect to gratuity, whether it is funded or unfunded, how you are estimating your liability, it is based on projected unit credit method. All those things needs to be disclosed in the accounting policies. Then the corresponding expense, when you account for expense, it will be a part of employee benefit expense. So there also the schedule 3 has categorically given the subheads within which the expenses needs to be grouped. The one is salaries and wages. Other thing is contribution to provident fund and other funds, and your share-based ESOP related things and staff welfare expenses. These heads are by and large same between all divisions of Schedule 3. IGAP or you will have one more any other expense, but by our concentration is between head 1 and 2 only, which is same for all 3 divisions: salaries and wages, contribution to provident fund and other funds. So here salaries, wages, your incentives, and all your payment with respect to gratuity, if it is not to a fund, if it is unfunded, as per Schedule 3, you have to group it with salaries and wages only. But if you want to differentiate, you can add one more line: provision for gratuity, because it is not a payment to a fund. Because we have seen many entities including the provision for gratuity, which is an unfunded scheme. In those cases, they were including it into contribution to provident or other fund. The company has, in this case that I'm explaining, they do not have a fund. So if there is no fund, it should not be included there. That is with respect to gratuity. Your PF ESI contribution, it is to the respective fund. So it has to be included in contribution to provident fund and other funds only. So ESI also will come here. But the catch is on gratuity. Gratuity, some companies are including here. If it is to a fund, yes, it has to be included in the second category. If it is not to a fund, then it has to be included in salaries and wages. And if it is a provision, you want to differentiate between salary and provision for gratuity, a separate line item needs to be included. And some companies, I think it should be by mistake, they have included the PF ESI contribution amount to staff welfare expenses. That should never happen. These labor law related, whatever we are discussing, PF, ESI, gratuity, none of these things should be included in staff welfare expenses. So that is with respect to this one. Define the contribution plan. Again, by and large, PF and ESI will be a defined contribution plan. But there can be cases where that we will be discussing subsequently. After contributing your monthly contribution, if you have anything else to be paid, then it is not a defined contribution plan. It should be defined benefit plan. We have references of standard also that we will be discussing later. When in respect of the liability side, PF ESI can be shown as amount payable, statutory dues payable in other current liability. But with respect to gratuity, there are 2 cases. Your fund, your plan may be a funded plan or unfunded plan. So first, let us take in case of funded plan. In case of funded plan, whatever is the liability, that will be remitted to the fund within next 1 year. So entire amount will be short-term liability. There is, in case of funded plan, generally there will not be any long-term and short-term concept. It will be fully short-term. If it is unfunded liability, then the actuary who is determining the total liability, they will give bifurcation between how much is short-term and what portion of the total liability is long-term. That has to be grouped into non-current portion of gratuity to be shown as long-term provision, and the current portion of gratuity liability should be presented as short-term provision. Even here also, some entities have grouped this liability into other current liability, which is not the correct case. It has to be in provision only. Okay, so that is with respect to gratuity and its provision. Again, in case of gratuity, in case of Ind AS applicable company, the valuer will give bifurcation between what is attributable to profit and loss account, and out of total debit, how much has to go to P&L and how much has to go to other comprehensive income. The actuarial gain or loss will be routed through other comprehensive income. With respect to other comprehensive income, there can be gain or loss also. Again, in gratuity also, the basic thing, there can be credit or debit. It has to be presented as the case may be. So that we have discussed provision part, and contingent liability we have discussed in earlier slides itself. So I'm not again repeating the same. There can be a contingent liability because you are really not sure whether it will happen or not happen. If that be the case, you have to disclose. If there is a demand, though you may be correct, but the authorities, you have to prefer an appeal, or you have to represent and say that you are not liable to pay. In those cases, as there is a demand on the company, it has to be necessarily disclosed as claims against the company, not acknowledged as debt. But you have taken the liability, and provision disclosure is sufficient. Okay, so that is with respect to disclosure in financial statement. Then comes the reporting requirement. So the adequacy of provision we discussed in detail, so I don't want to repeat it. Whenever there is a trigger with respect to non-compliance, you have to evaluate, and if necessary, you have to create adequate provision. So if the provision is created due to fund flow issue, wherever applicable along with the interest, but due to fund flow issue, the company is yet to make payment, or it is identified only during the course of audit, they couldn't couldn't make the payment within the year end because it has happened subsequently. If the provision is created, payment is not necessary. If the financials is showing true and fair view, it is necessary. It is sufficient if adequate provisions are created. Then with respect to CARO, your class 7A and B is dealing with respect to this CARO reporting. That is what I'm saying. You are expected to comment on the regularity of the payment. That is, point A has two things: whether the company is regular in making undisputed statutory dues. It includes of various dues, PF and DSC is also covered. That is number one. And if not, the extent of arrears which is outstanding on the last day of the financial year concerned, that is as at the balance sheet date, which is for the period more than 6 months from the day they become payable. So if only Jan, Feb, March dues are outstanding, then it is not outstanding for a period more than 6 months. So those dues will not be disclosed in the second thing, undisputed due outstanding for more than 6 months. Only the more than 6 months as on the balance sheet date, from the date it become payable, is the critical thing that has to be looked into at the time of reporting. Then comes the disputed due. There is a due, but you don't want to remit it. You have filed an appeal. So in that case, if there is a dispute is filed as an appeal, then you have to disclose here. Statutory dues referred in class above which have not been deposited on account of any dispute, then the amount involved and the forum against which it is pending, that needs to be reported. Mere representation, giving normal letter is not sufficient. If the format or the way in which it has to be filed, the appeal needs to be filed. If it is presented, then it has to be filed as an appeal. Then only you can come here. Just a filing of letter or response to the demand is not sufficient. So that is also clearly spelled. And with respect to IFC, we discussed in our audit related point earlier also. Here in IFC reporting, we will be commenting on two things: the design efficiency and operating efficiency of the controls. So we will restrict this with respect to the labor laws. So what are all the controls that have been designed to ensure that the entity is in compliance with respect to the law and the reported balances? See, again, IFC reporting is not only on material transaction and material balances, it is also on disclosures. So the disclosure also should be proper. So you should have control in place that the disclosures are proper. So what are all the whether the controls have been designed effectively and whether the controls are operating effectively, who is preparing, who is checking, and what is the evidence that are available to substantiate that this control has actually happened. So those things have to be reviewed and we have to give our report on IFC if applicable. Then comes tax audit. Again, it is the place where we have to have some reconciliation, and because I have seen many companies which is where you have a separate HR department or you have a separate outsourced what you can say payroll consultancy. So they will be based on your pay slip and other information shared. The computation will be proper. What is the employer contribution? What is the employee contribution? Everything will be shared, and they will ask you to make this much payment on so and so matter. So the payment will be made, even in case of the company having their own what you can say HR department. They will be giving the amount which needs to be paid. So sometimes we have been informed that it has been reviewed by the finance team also, but I am not sure in many cases how effective that review is. If it is properly authorized by head, and I think the team is going ahead and making payment. So if we have to have there is an annexure which has to disclose what is the employee contribution on a month-on-month basis, what is the due date and the date on which it has been paid. That needs to be disclosed in the tax audit report. And with respect to employer contribution also, you have to give in 43B, whether in case of either any dues which have happened during the year that has been whether subsequently paid or not, and relating to earlier year also, what is the carry forward which is not paid and of which what is paid within the year. So this 4 tables, or there are 4 reporting requirement with respect to employer contribution under section 43B, and employee contribution also needs to be disclosed, because here there is one more point to keep in mind. I think it is nowadays it is common, everybody is aware of the employee contribution. It is not a matter of allowing it as expense at the time of payment, because the employee contribution, if it is not remitted within due date, it will be treated as income. So once it is treated as income, there is no concept of allowing it when it is paid, because the act has been amended in 2021, I think, with more clarity that the due date that is mentioned in 43B is not at all applicable to this case. Here, if you reduced or if you have deducted any amount from employee, and if you have not remitted within due date, it is your income. That's all. You have to offer it as income, pay tax. There ends the story. And even if the companies are proper, they are remitting on time also, the disclosure of annexure in tax audit, annexure form 3CD is mandatory. So to have a proper disclosure in tax audit, you have to track what is employee contribution and what is employer contribution. Again, with respect to gratuity, there are two things. Number one, the company may have a funded gratuity plan, or it may have unfunded gratuity plan. So if it is unfunded gratuity plan, whatever provision is created in books, that will be disallowed. Whatever is the actual payment that have been made to the employee as gratuity, that will be allowed. It is as simple as that. In 40A class, whatever is the debit to P&L less whatever is paid during the year, you can straight away allow it, and balance will be disallowed. That is a clear case with respect to unfunded scheme. With respect to funded scheme, the moment you create, in first case, if it is unfunded, everything ends within the year. Whatever is debited less whatever is paid will be disallowed. Meaning, if it is paid, it will be allowed. If it is unpaid, it will be disallowed. As simple as that. With respect to funded scheme, it will be covered under section 43B. There you have time till the due date for filing return. So whatever is the provision which is outstanding, it is similar to the employer contribution in case of PF and DSI. So if it is incurred during the year, you have time till the due date for filing return. But here again, you should have a catch. I think now the department is comparing what the auditor is disclosing in the tax audit report and what is filed by the company in the return. So there can be cases where tax audit has been concluded and signed off a month ahead of your due date, but the return you have filed little later. There can be some payment of bonus or gratuity or what you can say, employer contribution between. Mainly it is the case of bonus and maybe gratuity. So you should have a track between how much has been, what is disclosed in the tax audit report, what you are claiming in return, and you should have a clear evidence of this has been paid between these two dates. Accordingly, it has been claimed as a deduction. And when you take to the next year, you have to ensure that from your ITR, from your tax audit disclosure, which is already claimed as deduction, has been eliminated. That control you have to have it, so that otherwise there will be cases of double claiming may happen. So to avoid that, we should have a proper working. So then we are coming to the next section, the observations by the reviewers. Now I am restricting this to quality review board and financial reporting review board. So accounting policy with respect to defined contribution plan and defined benefit plan is not appropriately disclosed. That's what I'm saying. Generally, if the companies are making contribution to PF, the fund that is run by government, then it will be defined contribution plan, because after that, once you contribute on a monthly basis, employer contribution and employee contribution, there is no further liability on the company. So that needs to be given. And your defined benefit plan, gratuity related accounting policy, whether you are doing actuarial valuation and whether the projected unit credit method is used, and it is, all those things needs to be disclosed. Some non-compliance with respect to disclosure is identified. Second is non-compliance with Schedule 3. Contribution to PF ESA are included in staff welfare costs. That is what I have discussed in the previous slide when we discuss about your disclosure requirement. So that is one non-compliance. Then the current and non-current portion of gratuity is not appropriately disclosed. In some cases, everything is shown as current, everything is shown as non-current, everything is grouped under other current liability. Those things are not correct. This is the observation. And in case of funded gratuity plan, the liability is presented as current and non-current instead of presenting it fully as current, because anyhow you will be making the payment within the next year. So within 1 year, whatever is paid will be treated as current. That is the thing. Then disclosure as per AS or Ind AS with respect to gratuity liability asset movement. Again, there is a detailed disclosure requirement. Even in case of any provision, if there is some other act is covering the disclosure requirement, in case of, if you say payment of gratuity, the disclosure requirements are covered under the standard. But if it is not covered under any other standard, you have to give what is the opening provision, what is additional provision during the year, what is utilized, and what is the closing balance. The movement needs to be given for all provision. But here, with respect to gratuity, movement in fair value of plan asset, movement in fair value of present value of obligation, and your actuarial assumptions, and what is the movement in expense, everything needs to be disclosed. All disclosure requirement, the source data will be provided by actuary. We have to validate whether the number of employees and other counts are in agreement with the data shared with him. Once we are having enough comfort on the report, then we can disclose the numbers, and the whatever we are disclosing as closing balance should agree with the sum total of current and non-current liability that you are disclosing in the liability side. Similarly, whatever you are accounting it as expense to be debited to P&L, it should match with your P&L component, and OCA should match the cross-link review, the cross tally between notes and financials to be ensured. Then comments or observation from FRRB. So this is mainly the case. Here the subject company is having their own trust. The fund is administered through a trust. So the company is making monthly contribution. Based on the contribution, the trust is making investment into the specific securities, or it is making fixed deposit as per the approved policy of the trust. But when the employees are when the trust is liable to make payment to the employee, if the trust is running short of money, then the company has to compensate the shortfall. That is the original plan between the company and the trust. So in that case, the company has mentioned this as a defined contribution plan. Actually, it is not a defined contribution plan. If you go through this, there is no gap difference between accounting standard 15 and Ind AS 19 with respect to this definition. Both are same only. Defined contribution plan or post-employment benefit plan, again PF ESI, generally the benefit will be given post-employment, given which an entity pays a fixed contribution to a separate entity, a fund, and will have no legal or constructive obligation to pay further contribution if the fund does not hold sufficient asset to repay all liability, all employee benefit liability when the corresponding period comes. Okay, so here in the case, as we said, if there is any shortfall, the company has to make good the loss. But as per the definition, over and above fixed contribution, the company should not have any legal or constructive obligation. So this criteria is not met. So the second definition says defined benefit plan or post-employment benefit plan other than defined contribution plan. So in this case, PF ESI also will be covered under defined benefit plan only, but the company has disclosed it as a contribution plan, which is a non-compliance noticed by FRRB. And the other thing is, we discussed in the reporting point, the auditor has to report on undisputed dues and disputed dues and regularity of the payment. The auditor has not mentioned all dues in his report. He has mentioned only few. It can be cases where others are not applicable or whatever it is. To be on a safer side, it is suggested to document whatever is your observation and to disclose whatever is the fact. CARO is generally a statement of fact. It has to be disclosed. Other dues are not applicable and hence not reported. Or all other dues other than this are remitted on time. These dues are not applicable to the company. It is better to give clearly the facts. So that's all by and large I want to say with respect to the labor laws and related audit consideration. So if any of you have any of the question, we can discuss that. And some, as I told, we will be before, I think we have some 5 minutes maximum. So we will be discussing some practical issues that has been identified during the course of audit or discussed within the circle. Generally, the companies are not able to make PF contribution because of the UAN number is not available, or there are some issue because of that. Here again, we have to take a materiality call, number one, and number two, if it is outstanding for, again, many companies are taking precaution when they onboard itself, all the appointment formalities are proper, and then only they are taking on board, so that you will not have an issue of taken on board, but you are not able to contribute because of the practical issue. So care has to be taken. Adequate disclosure. If the company is not able to make payment because of these procedural aspects, then you have to disclose the facts considering the materiality and other things. And apprentice, this is the main thing we discussed. Many initial period, 1 or 2 years, companies are taking the labor force as apprentice, and they are not complying with the PFESA gratuity and bonus act. So only if they are covered under the act, they have to be excluded. That is one common non-compliance that has been noted. And contract employee, there are cases where the contract employee PFESA compliances are not ensured. That is the cases. And again, in some cases where the employees, it's unorganized sector like construction, other thing, employees are asking for a fixed, say, some say 12,000, 50,000, you pay me, you don't deduct anything. So in those cases, both employee contributions are made by the company, but proper documentation or backworking is not done. That is one of the non-compliances noticed. And minimum bonus is not paid. And the provision is also not made. That is the other non-compliance noticed. But in some cases, the provisions are made as per our insisting to create provision. But when we come to the next year for audit, or when we review, the same balance is appearing as it is. There is a provision, but the payment is not made. It is not sufficient to create provision. Also, the amount has to be paid within 8 months from the end of the year if there are no dispute. So the payment is either it is not provided, or even after provided also in some cases it is not paid. That is one of the issue. And overtime, in case of busy schedule, if the companies are going for overtime, the overtime payment has to be paid double the rate when compared to normal wage rate. So that is not done. Some companies are paying only a normal rate, or some companies are paying only 1.5. Those things are not permitted. As per the Factories Act, double the time it has to be paid. And employees working hours in a week should be restricted to 48 hours. So these things mainly can be brought from internal audit or other internal review. Only as auditor, it will be very difficult to identify how many hours every employee has worked. But as I told, the company should have a system and checks in place to ensure that they are not violating the Factories Act. Because if the employees are worked, you will be making payment by going through the how much you have paid to an employee in a week. Easily, anyone can work out how much hours he has worked. So when it is at the company level, these controls needs to be put in place to ensure that they are not violating the act. Actuarial valuation related non-compliances, we have seen error in data sent to actuary, we have discussed. Again, there can be practical cases where some employees have completed their service towards the fag end, maybe from 25th to 30th of March. So as at the year end, when we send the data to actuary for valuation, we will know that these employees are not on roll. But the employees are removed from the list and only the existing employees are sent. If it is unfunded scheme, generally there will not be any problem, because with respect to the resigned employee, if the settlement is not made, there is no more estimation involved. You know how many years he has worked, and every information necessary for computation of gratuity is available. You will be creating a provision. So in that case, it is not a problem. In case of funded plan, you have funded for him also based on the estimation. So as one employee has left the organization, the funding has to happen from the fund, trust, the group gratuity trust or fund that is with LIC or some other organization. So till the time the amount is not going out from the fund, the corresponding liability to be retained in the books, then only the matching will happen. Otherwise, with respect to 5 employees, you would have reduced your liability, but for them, the corresponding amount would have not been paid from the fund. So matching needs to be ensured. That is missing in some cases. Wherever the employees are removed from the list, you have to ensure that the settlement has happened for those employees from the fund. Instead of assessing, so the evaluation of notices and demand, that is not proper. Generally, companies are waiting for demand to come. In many cases, that is not the case. You have to assess the probability of payment and do it accordingly. Some cases, various data is submitted to various forum. There is no reconciliation or other thing available. That should also be taken care. Ideally, there should not be any differences, but there are genuine differences, applicability and non-applicability between the acts and other thing. You should have a proper reconciliation. So to respond to the queries, if any, coming in future. So that's all with respect to the practical issues that we have been informed by our clients or our friends and known circle also. So now I am open for questions, if any. Over to you, Rahman.
Sir, this is a technical person from SIRC.
Yes, sir.
There are 2 questions from.
I'm just going through. Give me some time. I'll just respond to this, sir.
Okay.
Threshold for number of employees is exceeded, but the threshold for wage doesn't Age limit doesn't. Still, do we need to go for ESI and PF? Yes, there are many cases where the companies are registering because of the number of employees and they are filing nil return. So the registration requirement is there. Then you have to submit nil return also, because the registration is based on number of employee. Then the contribution and other things are based on the limit. So for the first question, yes, the company has to go for registration. Second, if the number of employees more than 10 and total salary of all employees are more than 20, in this case, yeah, the question is more or less same. The answer is also same. Yes. So because the applicability side, we have to see, is there any grace period from PF ESA contribution? See, what I can understand is previously you have to do computations manually and you have to make the payment by check, and considering those things into account, some 5 days grace period has been given. But if my understanding is correct, those things have been removed. I don't think there is any grace period available. You have to pay as per the due date specified in Act only as on days. There is no grace period available. That is what is my understanding. So as of now, I am seeing 3 questions and I think I have responded everything. Is there any other question? Anyone wants to raise any question? I am happy to answer to the extent I can, or I can respond to them offline also if it requires further references from my end.
As of now, there is only 3 questions, sir.
Yeah, and I think I have answered all 3.
Okay.
Yeah.
Okay. Shall we end the session, sir?
Yeah, so before you end the session, I want to thank all participants for their passive, your patient listening and posting some question, which made me give a feeling that it was useful, and I think whatever best I can do within the time I have done. Again, I thank SIRC for your for giving me this opportunity to share my views with the fellow members. I thank entire SIRC team, your technical team, and other members also who supporting and who helped us to have this session. Yeah, over to you.
I would like to thank you, sir, CA Sivaraman sir, for making excellent session and making this session interesting and meaningful. Thank you so much, sir.
Just a minute, if you can hold it, Mr. Ramanathan has raised his hand. So
Sure.
whether you can enable him keep speaking, or is it possible?
Sure. I will allow him.
Yeah.
Sir, good evening, sir.
Yes, sir. Good evening.
Yeah. So, how do you define a contract employee? See, some of the companies will have a daily wages, right? So, what is the key point for you to consider as a contract employee? If a contract employee, we have to consider for PF, ESA, everything for the total numbers, correct? So,
yes.
Is there any documentation you strictly follow, or if it's a daily wages, daily they will come in the factory gate, and depending upon the need, the employer will be taking them. Or if it is like that, every week they may be paying. So how do you consider? Do you have to consider them, or how it is, sir?
Yes, sir. We have to consider them, because in all act they say including contract employee also. So considering the volume, I think if you are engaging on a daily basis, and if it is on a weekly basis, you are making payment also, you have to see what is the volume. If it is a very small amount, and even if it is, again, we should not say that, but if it is practically the cost of maintaining all those things is more than the benefit or the risk that you carry, then you can take a risk. But it is as per the act, yes, you contract, all employees are covered. You have to, because it, as you said, it is happening on a continuous basis. Better to engage a proper contractor who will have the specific employees, and you can make the contribution, and to have proper control on that. It is applicable as per the provisions of the act. Yes, it is applicable.
Fine. Only thing is that if the same guy is coming for a month, then there is no problem. So today he will be coming. Tomorrow he may not be coming. After 2 months he may be coming. So that is so.
No, if my memory is correct, a company has received a notice for some 10,000 or 20, very small amount. It relates to a person who has come for a repair and maintenance work for a week in their office. Okay, so even they don't even know where he is as on today when they receive the notice, who has done the work, whether he is available or not, where he is, those information are not available with the company. But the authority said ESA is applicable to them. You have to pay this due tax along with the interest and penalty, the dues that the company has paid. So it is for the company to have all the record, and if it is going to be a significant amount, it is better to engage a proper contractor who will give you with the employee who are registered, their registration and all those things, and get a copy of proof of payment of tax also, payment of PFASA also. That is the better thing.
Oh, fine. Thank you, sir. Thank you.
Thank you.
Yeah.
Yes. Yes, sir. I think we can. I think all the queries are answered. Now it's over to you, sir. You are on mute, Rahman, sir.
Thank you very much, Sivaraman sir. With that, we have come to the conclusion of today's program. Thank you one and all for your valuable time and presence. Thank you. Good night.
Thank you.
Thank you,
Have a
sir.
nice night.
Thank you.